what's your max upside for the S&P 500 if you're an analyst right now? Maybe 10, 15%, something like that. Okay, great. Well, based on those valuations, what's your max downside? Especially looking at the labor market. And if we are in that 2007, 2008 cycle, then you've got 30, 40, 50% downside on the S&P 500. And that's definitely asymmetry, but that's the opposite asymmetry.
Right.
That's the bad kind of asymmetry.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Concerns about the weak consumer, the frozen jobs and housing markets, rising debt delinquencies, tariff-driven inflation, stubbornly high bond yields, and geopolitical stresses cause many analysts to worry that the economy will slow materially this year. But others, especially those listening to the Trump administration, are predicting the economy will boom in 2026. From all the AI capex spending, the energy grid buildout, reshoring of manufacturing, capital influx from new trade deals, deregulation, historic tax refunds, and other commerce-friendly developments. So, which is it? Will the economy slow or grow this year? To discuss, we've got the good fortune to welcome back George Gammon to the program. George is best known for his financial education media endeavors, most notably his George Gammon and Rebel Capitalist YouTube channels. George, thanks so much for joining us today.
Thanks for having me on.
Hey, it's a pleasure to have you back on, my friend. Well, look, there's a lot going on in the world right now.
Yeah.
I even haven't had much of a chance to watch it today because I've been recording, but obviously
It's
the
just the taco
president's
trade.
Pardon me?
It's just the taco trade.
The taco trade. Okay. But
Yeah.
anyways, presidents at Davos, there's a lot of developments swirling there. I'm sure we'll talk to a number of them. But why don't we start with the question that I just posed here in the introduction about the economy, whether it will slow or grow this year. Do you have a strong opinion one direction or the other?
I think it's important for the audience to know that it's always doing both. It's just to what degree.
Right.
So as an example, what you're talking about there with the AI capex spend, that will probably continue, and I'm assuming we're going to get a lot of fiscal, but that doesn't necessarily mean that the high water mark increases. Because if you have a bucket of water and you're pouring water in at the top, but water's draining out at the bottom, you could just be maintaining that level.
Sure.
And that's what I'm trying to say. So the question isn't whether water's coming in or water's going out, because that's definite. We know that for sure. It's just, is that level of water going to decrease or increase? And usually the two metrics that I would look at the most would be just GDP and the labor market. But what's interesting is they're telling two completely different stories. So you look at, and I think GDP is actually coming out tomorrow. We're talking on January 21st. So that'll be really interesting, or at least a revision. But the labor market, when you look at non-farm payrolls, we've had several negative numbers in 2025. I know it's 2026 now, but back last year, we had several negative prints, and that's before the absolute final revisions. And I went back for a couple videos and did some research there, and I found that that's very rare outside of recession. Now, sometimes you get a one-off because of a big weather event or maybe a huge employer like Walmart, the employees going on strike or something like that.
Mm-hmm. A government shutdown. I mean,
there you go. I was just going to say government shutdown. But usually you just get this bounce back and then you get back to that same mark. It's very rare that you get 3, 4, 5, 6 months after revisions of negative non-farm payrolls outside of a recession. And if I had to place the emphasis on one indicator, it would definitely be the labor market. Mm-hmm. So if I was trying to predict the economy. Now, that said, I don't think that has anything to do with the stock market. Unfortunately, I think that a lot of people get confused that, oh my gosh, if the stock market's going up, well, then all you people that have been bearish on the economy, well, then you're all wrong. And that's not true. There can be an inverse relationship, because bad news is good news. Because if the labor market's deteriorating, then the Fed's going to drop rates, and you get this Pavlovian response where it's Jim Cramer, buy, 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 buy. And you combine that with the passive that our good friend Mike Green always talks about, and that usually leads to the stock market going up regardless of what's happened to the underlying economy. But your question is directed toward the economy itself. So
It
that's why I
is.
wanted to focus on nominal GDP and the labor market. Now, one of those two has to give, Adam. My base case would be that it's going to be GDP, but I don't know. Those two have to match up at some point in time. You can't have the labor market deteriorating. You can't have negative non-farm payrolls and very poor ADP prints and have GDP at 4.3%. Like that that's those two don't coincide. So my guess would be that the GDP comes down, especially after revisions, to what we see in the labor market versus the labor market really, really heating up and going back or getting up to the levels that would be reflective of a 4.3% real GDP.
Okay. Let me say a couple things about that. First off, personally, I don't think we're there yet. Um, but just to your question about, hey, you can't have GDP growth go up if basically jobs are flatlining.
Or negative.
Yeah, or negative, but let's just assume flatlining for a
Yeah.
second. In kind of an AI world where you're getting lots of new productivity from
Mm,
technology, could we eventually transition to an economy like that?
it's possible. It's definitely possible. I mean, what I would like to do there is go back and see when we have these huge fundamental shifts in these transitions, when we become much more productive, like the internet, I think would be good, and see how that kind of played out. But the internet didn't really take that many jobs. I don't know that that's an apples to apples comparison. You might have to go back to like when we were an agrarian economy, and 95% of Americans were farmers.
Right.
And then that kind of went by the wayside, and people had to learn other jobs and they become much more productive. But that happens over a period of what, 20, 30, 40 years, where this could happen over a period of maybe 3, 4, 5 years, something like that. It's definitely a component, and it's something that we need to consider. But if it's taking all those jobs, I don't know that it can increase productivity to the degree to which we would need in order for it to compensate the decrease in jobs. And I think that could be a lot of what we're seeing in the labor market right now, because that's just a complete reduction in aggregate demand. And in an economy, especially where you have to have the money supply grow, I don't like that, but it
Mhm.
kind of is what it is. If you have long periods of time where the money supply decreases as a result of more loans being paid off than are creating, that creates some deflation and disinflationary um, uh, tail or some inflation, excuse me, some deflationary or disinflationary um, currents that could be extremely detrimental. So I think on net, you would see a decrease in GDP overall, but it's definitely something that you got to consider. That's for sure. And I think the latest round of the productivity numbers show that productivity is definitely increasing.
Yeah. And like I said, I don't think we're there yet. I don't think it's kind of we're not going to see go from one year to the next and just all of a sudden see a completely different regime. But it could be a lot faster this time around, and I actually think it will be.
Absolutely.
Um, okay, so let's chew on this topic of jobs for a bit more. So first off, you know, we have to determine if the numbers that we have are even really trustworthy, right? And
Mhm.
the BLS has, I think, taken a lot of well-deserved criticism for
Yep.
its calculations. And even I was kind of shocked. I think this was two press conferences ago by Powell. But even Powell said that the Fed thinks that they've been overstated by, I think, on average of about $60,000, the
Yeah,
payroll numbers.
60,000. Yep.
Yeah, and if you back out that 60,000, then it's uh, job growth was negative for, a pretty good chunk of
Yeah.
2025.
Like the last 6 months, it's like negative 40,000 or negative 20,000.
Yeah, yeah. So, definitely reasons to be concerned. I do think that that was a good chunk of why the Fed was cutting in 2025. It was getting increasingly worried about the labor market. But, things have held together. And looking into 2025, um, well, two things. The Fed was concerned, and I and a lot of the analysts I interviewed were concerned about this trend. But like consumer spending it didn't grow a lot, certainly in real terms in 2025, but it didn't fall off a cliff either. We weren't really
Mm,
seeing a big diminishing, and that's because of this K-shaped economy. So with this K-shaped economy, George, we've got the top half of the K doing great. I've seen numbers, estimates that the top 10% is responsible for about 50% of retail
yeah.
sales. But whatever the true number is, they really punch above their weight, and they're able to kind of mask um, the declining prospects of the bottom 80 plus percent of the K, at least for the time being, right? And that seemed to be the case for 2025. Um, as we head into 2026, uh, at least if you listen to the administration, they're saying, hey, relief is coming for Main Street. We're going to have the biggest tax refunds for the middle class that we've ever had historically. There might even be tariff checks to households. Trump was talking about, I haven't heard much about it recently, but there could
Yeah.
be, direct payments like that. But also just like, hey, we kind of have this slow to hire, slow to fire economy right now, but hiring might pick up because we're building all these data centers and we're building all these new factories that are coming in, and all this, foreign capital that's coming in. It's all going to be great. The golden age is going to start kicking in. If you listen to folks like Lutnick and Besant, and yeah, of course they're going to be cheerleaders for the administration, but they're kind of putting their personal brands at risk by predicting GDP is going to be at least 5. And they've said, look, we can see cases where it's 6% or even higher in 2026. Right.
Mm.
So, time will tell who's right here. But I'm just curious, you know, as long as there's not a market correction, right? So as long as the top 10% is, or the top half of the K is still spending a lot, if we get some relief on some of these other things the administration is saying may be coming, um, it's I've got a hold possibility here that outlook, could be improving for the jobs market going in 2026. I won't believe it until I start seeing it in the numbers, but I'm holding it open in my mind that okay, maybe it's not going to be as bad as I thought, say if you'd asked me six months ago.
Mm. Yeah, I mean, it's a good point, but I think my counterpoint there would be, what are we going to see in 2026 that we didn't see in 2025 and still had the negative non-farm payrolls and the deterioration in the labor market? And the point about the K-shaped economy is very, very good, but I don't know that the top 1% spend more next year. I don't know why they would unless we just have like some sort of crack up boom in
Hmm.
assets or something, which you never know. I don't know if you saw the report from Macy's that just came out, where they're shutting down some of their,
Yep.
hub centers or something like this and firing a lot of employees. But what they mentioned is that they have to start catering more to the high end, and because those are the only people that are spending money.
Any money?
And it's
Yeah.
the same thing
Same
with
thing with the
Delta.
airlines.
Yeah, I was going to say with
They're
Delta
now totally
Airlines.
focusing on first person business. Yeah.
Yeah, so you have to, if that is the driver, or if that's what's keeping our head above water right now, then okay, we know that the labor market is likely to continue to deteriorate, so that's going to be a headwind. So for the top 1%, what drives the spending next year above and beyond what it was this year? And I think the probability of that is low, although I think there's a substantial probability that we see something similar where we still are able to keep our head afloat due to the spending from the top 1%, to your point, assuming that asset prices stay the same. And, we got gold all-time highs. We've got
Hmm.
silver going to the moon. So there's a lot of things out there that could lead to, let's say, additional aggregate demand for the top 1%. But at the end of the day, I think those chickens come home to roost. We have to remember that going back to the last big recession that we had in 2008, the lead up to that, the stock market was at all-time highs. Now, it is true that I think there's an increased percentage of aggregate demand coming from that portion, meaning asset prices. But back then, we had housing prices I mean, that was creating massive amounts of artificial aggregate demand
Yep.
until like 2006 going into 2007. And then the stock market peaked out in October of 2007, if my memory serves me right. And then we saw a gradual decline, then a big decline in 2008. But I don't know that this cycle plays out any different. And what you're saying, you're making very good points, but that's really the argument for Keynesian economics.
Well, I guess what I'm saying here is I can see potential. And again, I'm right now, there's lots of cross currents. So, I won't be surprised which way it goes. I'm just open to
Yeah.
both sides of the equation here. I guess what I'm saying is I could see potential that the job market actually might improve next year with a faster growing economy. And that was sort of the first thing I wanted to talk with you about, and I think we've done that. Um, the second thing I want to talk with you about, though, is the economy and the stock markets are two different things. And they have been so correlated for so long that I think everybody just thinks, well, they're both going to always go in the same direction, but they don't necessarily have to. So now, if we're talking about valuations, which we're getting into, we could have a year of increased economic growth, while at the same time, we could have a poor or bad market. And you're talking
Let's,
about, we're starting it with these nosebleed valuation levels.
yeah, see, that I disagree with.
Okay,
Again, there are no certainties, only probability. But if
right.
you're going to tell me the stock market, the S&P 500, we'll use that as a proxy, is down by 15% in 2026, I peg the probability of 4% GDP growth extremely, extremely low. And if you're talking about the numbers that Trump or the administration, 5, 6%, I'd peg that as close to zero as I can get.
Yeah.
Because, and we
Well,
also have to remember,
let's talk about why, because generally I agree with you that the market's become so important. It's kind of
yeah,
become the tail
exactly,
that now wags the dog.
exactly.
And of course, we're talking about the top the top part of the K, right? If all of a sudden their assets get injured and they pull in their spending, that's really going to impact the economy.
Yeah, to your
But
point, that is aggregate demand right now. That is
yeah,
what's keeping our head above water is asset prices. So if asset prices go down, I don't know how we don't drown in that scenario. At least especially when you look at the curves and you look at interest rates and you look at what they're doing as well. They're telling the story of a slowing of nominal GDP, not an acceleration.
okay. So from your perspective, you're taking the hey, show me standpoint when it comes to what the administration's selling right now.
Yeah, I mean, if you're going to tell me that GDP is even going to stay the same, let's say 3% for 2026,
Hmm.
I would say that we need the stock market to go up by another 25%. And like I said, if you're going to tell me that it's down by 20%, in that world, I'm going to peg negative GDP, the probabilities at 75%.
Okay. So, gosh, so much to dig into here then. Let's start
Especially with
with,
the housing market too, Adam, because I know you touch on that quite a bit,
yeah,
and rightfully so. And right now, I mean, what, 51% of the homes on Zillow took it on the chin last year, have had to take a haircut or at least decrease their price.
right. We had the majority of homes actually lose value last year. Yeah.
Yeah, so if you see that trend continue, and that's really interesting because the housing market is much different than the stock market from a standpoint. It's like the Titanic. Once that thing's moving in a certain direction, it takes a long time for it to turn around and go back the other way.
Right.
And right now, I think you're seeing that transition, if you will, where it's starting to go back the other way. And usually that doesn't play out for 5, 6, 7 years like we saw when we hit the peak in 2006 and we hit the bottom in 2012 of
Right.
August, about 6 years. So you figure, if we're 2 or 3 years into that, you've got another 2 or 3 years to go. So you would combine a reduction in overall home equity in addition to, let's just say, a decrease of 20% in the S&P 500. And that to me is aggregate demand. And so that's why I peg that probability so high. It's not just the stock market, it would be a combination with the housing market as well.
Okay. It makes total sense to me. So, I just want to get your opinion on valuations. So, for much of the past several years, um, stocks have risen to historic valuation extremes, and
Yeah,
they
yeah,
still are there right now. By metrics like whether it's CAPE ratios or Buffett indicator or whatever, we're at, if not all-time high. I think Buffett's at all-time high, but CAPE ratios are almost at all-time extremes.
yeah.
Um, so, do you have a forecast or at least an outlook for 2026 in terms of the markets? Do you think they're going to be able to hang out here, or even extend their multiples higher, or do you see some triggers that could potentially, force some sort of pullback or correction?
I think it goes back to labor market because for that, I think what really moves the needle is passive.
Okay.
And so if you have the unemployment rate under 5%, and let's say the job market does not continue to deteriorate, I think that could be enough of a tailwind
Okay.
to even push the
Just with those big
valuations.
passive flows coming from the
Yeah,
retirement buying. Yeah.
yeah, yeah. Now, a lot of people they watch your channel and they get some incredible information. And most of the people that come on your channel say that yes, we're at these nosebleed levels. It's insane where we are. It's definitely in a bubble, and I would completely agree with them. But unfortunately, and my viewers are the same, they take that to mean that you should go out there and short the S&P 500.
Yeah. Yeah.
And
Which,
that is a very, very, very dangerous game. And that is something that I would highly advise against just because you do have that, what does Mike call it? The brainless robot or whatever
the giant mindless robot.
there you go. The
Yeah.
most basic algorithm of all time. You don't want to fight that. You don't want to fight that. I think that's way more powerful than the Fed has ever been. And so I just don't like to get in the way of that freight train. So I think there's other ways to play it that are a little more strategic. I think maybe the last time that we spoke, I talked about that spread trade. And if
Yeah.
you want me to at the end of this video, I can explain that. But that's done very, very well. I would much prefer to do something like that if I have a bearish view on the valuations than just buy puts or something like that.
Okay. And I'll let you know that great minds like yours are in great company. Not only have I had, guys like Mike Green on who have just said, hey, look, I hate the fact that this passive bid is distorting the markets and creating kind of a sort of Damocles for the market where everything's going to be fine up until the point this thing reverses, then it's going to be
Yeah,
chaos. But he's like, but
yeah,
it is what it is. And he's done the work to isolate the passive factor. It's now something he's actually trading on. And he says, look, as long as that thing is going the way it is, you'd be foolish to fight it. But I also had Carson Block on from Muddy Waters last week,
mm,
one of the most respected short sellers still in the business.
yeah,
And he said the same thing. And actually, he actually is licensing Mike's data on the passive bid and using it to make profits on the long side. And he's just
yeah,
saying, yeah, I don't think he's like, I'm not that interested in shorting this market unless I've got an activist lever to pull. And he's like, I think if you're a regular person, you're nuts to be shorting. So, anyways, he thinks very
yeah.
similarly to you.
Especially with, I had lunch with Mike a couple months ago, and we were talking about this specifically. And I don't, it might be proprietary, so I won't give the exact number. But Mike said that he's modeled it out, and there is a line in the sand with unemployment where he thinks the passive will go from net buying to net selling.
That's telling, yeah.
So that's why I refer back to the labor market if someone's actually trying to time that.
Okay. I'm going to actually see Mike in person next month and I'll ask him that same
Are
question.
you going to
And
go to Jeff's deal?
no, I'm going to go to Grant and Stephanie's
Okay. Okay.
conference in Florida. Um, but I'll ask him too if it's proprietary, if that's something that he doesn't mind sharing. And if he is willing to share it, folks, I'll let everybody know.
Yeah.
And I'll let you know too, George, that you can share that publicly with your audience too. Um, uh, just because you've met Mike in person, I've interviewed Mike a fair amount over the years, but I've yet to meet him in person.
Hmm.
But he's one of those guys, I think, from what I've talked to from other people, is he's a pretty tall guy, isn't he?
He's a big dude.
Yeah.
He's a big
And
guy.
it's funny because for some reason, he doesn't come across that way on It's kind of like Brent Johnson. When I met Brent for
Yeah.
the first time, I was like, oh my God, you're a giant.
Yeah. Yeah. People
Yeah.
say that about me too.
Yeah, you are a tall guy. Yeah. Yeah. Okay. So yeah, I'm mentally preparing myself not to be surprised then when I see him in person.
Yeah.
Um, all right. So I agree with you that I think, so goes the labor market, so goes the economy, and the markets for 2025. Um, I guess let me ask you this, just how much do you worry about just valuations in general, right? They're a
Mm,
terrible timing tool, but I guess for you, you're probably not going to worry about them too much until the passive bid starts struggling.
yeah.
Um, uh, okay, and how
I mean,
much?
I worry about it from a standpoint of its impact on the economy. And the example I always use, Adam, is it's like a hot air balloon when the economy should be the balloon and the stock market should be the basket.
Mhm.
But unfortunately, what we have today is the complete opposite of that. It's the stock market is actually the balloon and the economy is the basket. And that's where I really worry about valuations. It's not necessarily because we could go into a big decline or 20, 30%. It's just the dependence that the economy now has on the stock market is what I worry about.
Yeah, and maybe well, I'll get to my question here eventually here. Uh, but so we've got again kind of the sort of Damocles of just valuations are kind of perpetually elevated at this point in time to extremes, and at some point that will likely mean revert, and then it could have really dire impact for the economy. And obviously, a flipping of the passive flows from positive to negative could be a trigger for that. Another one just could be the AI trade just kind of rolling over,
Yeah.
right? And so we talked about the importance of AI capital spending this year, but there's definitely been more skepticism growing in the AI story as 2025 moved on. And then, recently here at the beginning of 2026, yeah, I'm starting to see real stories questioning things like OpenAI's business model, right? That like, hey, the company seems to be in an internal panic. It seems like, Google Gemini might be kind of eating their lunch. But I mean, and we've got concerns about the circular financing, which of course we had during the dot-com boom and whatnot. But how much do you worry, if at all, that the bloom just comes off the AI rose enough?
And that is the S&P 500, and the S&P 500 is the economy.
Yeah, exactly. I
Yeah.
mean, yeah,
Yeah. Yeah,
yeah,
I think that's a great point. And there is no doubt that AI is the future. And we all agree on that.
right.
And it's
But
just,
just like the internet, will it be the future as fast as
yeah,
current valuations suggest? Yeah,
it's simply a matter of when. It's not a matter of if. But that doesn't necessarily mean that the current business models are profitable.
right.
And I mean, you look at
Or sorry to interrupt,
OpenAI.
or that the capex is going to continue at the rate that it is. I mean, there's a
It,
danger
it
that companies this year might just say, "Wait a minute, we're spending a ton and we're not
yeah.
seeing incremental revenue yet." Yeah.
It can't. It can't unless they come up with a different way to monetize, which will probably be ad driven or something like that. But until you get to that point, I mean, you've got OpenAI that's generating, right off the top of my head, I think it was in the 12, $15 billion worth of revenue. And like 80% of the globe uses OpenAI. So it's like, where's your growth strategy there, right?
Yeah.
And what are you going to charge people more money? You're already giving it away for free. And every single one of those queries costs you a hell of a lot more than 20 bucks a month.
Yeah.
When you combine it, if you're like a power user or like most people, where even for me, uh, uh, Chat GPT has almost replaced Google from a standpoint of search. Or at least, if I did 100% search 4 years ago, now it's probably 50-50
Right.
between Chat GPT and actually just Google search.
Right. And
So
even folks who use Google search, a lot of them are just now using the AI Gemini summary at the top. They're not clicking any of the links
yeah, I
below
do
to
that
make
too.
money. Yeah.
Yeah, I absolutely do that too. So I think if your listeners and viewers just look at their own habits and how they have changed and how they interact with the internet over the last year or year and a half, you see the direction this is going. But even you've had this massive growth, like unbelievably breakneck speed, but yet they're still not even close to making profit. And then you sit there and you ask, well, how are they going to do it with their existing business model? And the answer is they really can't, because at the end of the day, AI is a commodity. It's a commodity. So unless they figure out a different way to put up a moat or to create some sort of monopoly where they actually have pricing power, it's just simply a race to the bottom, where it is true that delivering the service will get cheaper and cheaper and cheaper and cheaper, but there's also going to be more and more competition that's willing to charge you, 5 cents less than the other guy just
Right.
to connect to that commodity. It's like a barrel of oil. And until you get to this point where the current businesses that are out there are really charging their input cost plus 1%.
Right.
And it's
Again,
like
it's just like the
AT&T.
dot-com era, right?
Yeah.
Everybody was saying, look at all my eyeballs. And everybody fell in love with that initially. But then they said, wait a minute. What we really care about at the end of the day is profits, and none of you have them. Yeah.
Yeah. And again, I'm sure they're going to come up with new models over the next 5 or 10 years or something like that, apps or who knows, that will be wildly profitable. But as the businesses are right now, and that's what you've got to trade on as far as the price and the stock, there's no way. And you sit there and you look at NVIDIA, and the argument there is, oh, they're wildly profitable and all these things. Okay, that's great. But, I was reading a statistic the other day. I don't know if this is fake news or not, so your audience can fact check me. But it was like 80% of NVIDIA's revenue comes from like 10 businesses.
Yeah.
It's like, and then you look at, so
And
sure,
businesses that
NVIDIA's,
it's often giving the money to then buy back from.
yeah, yeah, exactly. So sure, NVIDIA is profitable, but when you look at their customers, they're not profitable in the slightest. And they go from all this capex spend coming from the savings component of the balance sheet, or from profits from cash flow, whatever you want to call it, and now it starts turning into debt, and that's usually when you start to see the cycle. I'm sure Carson pointed that out
Mhm.
specifically. That's kind of when you see that
That late
fundamental
stage.
shift,
Yeah.
that
Yeah.
paradigm shift, and that's what we're seeing right now. So I think that's definitely going to be a headwind for the market going into 2026. Which, again, the reason that's important to your point, and what I would suggest your audience think about, is how relevant or how crucial the AI companies are to the S&P 500, and then how crucial the S&P 500 is to the majority of 401ks, and how crucial that is to aggregate demand in the overall economy.
Yeah. I mean, the thing is that I don't think they need to reflect on that all that much, because I think everybody knows the answer, which
Yeah.
is, they are crucial to the S&P, and the S&P is crucial to everybody's retirement funds.
Yeah. I mean, I think what you have to do as an investor is just look at the asymmetry, because at the end of the day, that's really what you're looking for.
Hmm.
You're looking for a lot more upside than downside based on the probabilities. And if you're telling me right now that you look out into 2026 and the upside, we've just got way, way, way more upside than we've got downside. I mean, I don't know how you're coming to that conclusion. Now you can sit there and say that, yeah, your base case is that we're up 5%. Okay, that's fine. But what's your max upside for the S&P 500 if you're an analyst right now? Maybe 10, 15%, something like that. Okay, great. Well, based on those valuations, what's your max downside? Especially looking at the labor market. And if we are in that 2007, 2008 cycle, then you've got 30, 40, 50% downside on the S&P 500. And that's definitely asymmetry, but that's the opposite asymmetry.
Right.
That's the bad kind of asymmetry.
Yeah, that's a great way to say it, George. All right. Well, okay. So I want to use that to again go to sort of your outlook for this year, real quick. This is fake news, but I tweeted, I don't know, it was a month or two ago, kind of at the height of all this circular investing in each other's companies, and I put up a false headline that said NVIDIA stocks pops 12% today on announcement that it's taking a 10% stake in NVIDIA.
Yeah, I did this. I did the same tweet. I did this. I swear I didn't see that. I had a very similar tweet to that.
Great minds.
Yeah, so I'm right there with you. Exactly. That's when it was just getting completely ridiculous. And I'm like,
As
okay,
the visual for it, I took a surge protector, right?
yeah,
The
plugged it
surge,
into
and it's
itself.
plugged into itself. Exactly. Yeah.
Yeah. Yeah.
Yeah.
Yeah. I mean that, but I think Nvidia is down since then pretty substantially.
Yeah.
And
Well, that's because Wall Street read our tweets, of course. Yeah.
there you go. There you go. So, again, what's your upside there? What's your downside? And I think that's where people need to be prudent.
Okay. So yeah, I think you did a really good job of saying, hey, the asymmetry doesn't seem to be favorable right now, at least for the dominant trades like the AI trade. Um, you've already told me you'll take the under on economic growth for this year versus projections. How about for the markets? I mean, first off, just statistically, we've had three 20%-ish years of return in the
Yeah,
stock
right.
market, which is
Right.
historically aberrant. A fourth year, just statistically, would be really hard. But obviously, then you factor in all these other, factors that we've been talking about here. Do you, you know, up, flat, down? Do you have a general outlook for 2026 for stocks?
Yeah, what's interesting is I think it depends on the decline.
Hmm.
So what
And
I mean
obviously, it'll
by
depend on
that,
what happens in the labor market. You've been real clear about that. Yeah.
yeah, but if you have like a 20%, let's say we get, yen carry trade or black swan or something blows up.
Oh, you'll
And
have a
as a
fast central planner response versus if it's
exactly,
just a slow burn. Yeah.
exactly. I think if you get a
Like a
big,
2022, another 20.
yeah, if you get that, I would say market's probably up. But if you get a slow grind down that really doesn't catch the attention of the central planners and it's really not that big of a deal, or it's not that big of a crisis to impact the midterm elections, and they just kind of sit back and don't do anything, then I think you could be down, 5, 10%, something like that. That'd probably be my base case. But I think that you're going to have some volatility, that's for sure.
Yeah.
And it just depends on how extreme that volatility is. And ironically enough, I think the more extreme it is, the more likely the response from the central planners, which feeds into that Pavlovian response from the market, which increases the odds of the S&P 500 ending the year higher.
Okay. All right. That makes total sense. And by the way, when I mentioned 2022, that was a year I think that it was slow enough that it didn't
Yeah,
give the central planners an excuse to say, okay, we gotta step in and do our usual,
exactly.
so all right. So you got your end the Fed hat on, George, as you're wont to do. So let me trundle over into the precious metals.
Yeah,
So they've just had a phenomenal run,
yeah.
phenomenal run. What is your take from that? Is this all just these things have been suppressed, mispriced, whatever, and the world is waking up, especially now that it's becoming much less globalized, and everybody's just realizing, hey, this is where true value lies, and we need to get more of it, and it's just true price discovery that's going on, or are there other things that are driving it? And I guess where I'm going with all this is after this big run, what's your attitude from them with them as an investment heading into 2026? Stick with it, prepare for a big pullback because it went too far too fast, or look, this thing's just getting started, and buy it with both hands still.
Well, I'm a big believer in trend is your friend.
Hmm.
So if we're just looking at it from a standpoint of what to do with your portfolio, I can't give you one personal investing advice, but I'm always going to stick with the trend. And right now the trend is definitely up. So now I think it's important to answer the question why,
Hmm.
because you can't just exclusively look at a chart. You've got to try to understand the fundamentals to the best of your ability. And one of the biggest mistakes that I see investors make is they get something right or wrong, and they assume the reason they got it right or wrong is because of what they think, and often it's the opposite of that, if that makes sense. So I can explain further in that let's assume for a moment that George Gammon came on Adam's show and said that the S&P 500 was going to go up by 20% in 2026 because the sixth moon of Jupiter is at a 46-degree angle in its
Hmm.
orbit as opposed to a 45-degree angle. Or yeah, obviously I'm just making this up.
Yep.
And and then let's just say that we fast forward and the S&P 500 goes up by 20%. Does that mean I'm right? Not really. And in fact, if I do get that right as far as my prediction in the market, but I come to the wrong conclusion as to why and what the fundamental drivers, that's really dangerous. That is really, really, really dangerous, because then what you usually do is double down on that, and eventually you're going to lose big,
Right.
because you're going to keep doubling down, tripling down, quadrupling down, and at some point the house wins.
Right. And for the
So
wrong reason. Right. It's
yeah,
back to the
so
old Mark Twain. It's what you know. It's not what you don't know that gets you in trouble. It's what you know for sure that just ain't so. Right.
yeah, that's right. That's
Yeah.
right. So when you look at gold, for me, and I could be wrong, but for me, it's not about what the normal narrative that you hear, and silver as well, which is debt and deficits. Because if you go back and look at research, the price of gold, and you try to find some sort of driver or some sort of correlation, as an example with inflation, a lot of people think gold is an inflation hedge, which over long periods of time it definitely is, but that doesn't mean that it is from year to year. And so just because the price of gold is going up, that doesn't necessarily mean that it's predicting inflation or money supply growth or negative real interest rates or a lower dollar or any of those things that have been associated with the price of gold in the past. Because again, you don't have to take my word on it. Just do a simple study and look at a chart of gold and then line it up with the CPI, line it up with those other things, and you're not going to find a correlation at all. But the
Right.
one thing where you will find a correlation, and I think today is a great example of that, is counterparty risk, right? Counterparty risk. So what I'm referring to specifically, Adam, is Trump over the weekend or whenever he stated that says that he wants to take over Greenland, and he's announcing these new tariffs, and he's going to put a 4,000% tariff on champagne or whatever
Mhm.
he's saying, right? And the market's like, whoa, 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 we didn't see that. So increase risk. You see that, and then what happens to gold and silver? They catch a huge bid. And
Right.
then today, Trump comes out and says, like he usually does, well, actually, I was just joking, and it was just kind of a late night on Twitter or Truth Social. And yeah, we're going to go ahead and, yeah, those 10% tariffs, that's not going to happen. And what happens to gold and silver? They tank, they completely sell off. And then what you have is the stock market rip, and you have interest rates plummet at the long end, the exact
Right.
opposite, right, of what
Right.
happens. So
And,
I think,
and just to validate that, that's exactly what's happening as we're talking
oh, is
following.
it?
Yeah, yeah. I mean, well, at Davis, Trump, right before we got on, Trump just issued a Truth Social saying, "Hey, I've just worked out the framework of a deal for Greenland
Yeah.
with the uh, Secretary General of NATO, and therefore I'm not going to put the tariffs on Europe that I was threatening." And S&P zoomed, and precious metals got whacked.
Yeah. So I think that is just in a microcosm, it tells you really what's driving price. And this goes back to Russia invading Ukraine in 2022 and us freezing the assets. And if you're these central banks around the world, and what are you going to do? You're going to buy something that doesn't have counterparty risk and that can't be seized by the US government. And I think that's where it's gold started picking up steam.
Right.
And then you have more and more and more geopolitical risk. You have Iran. You have us going in and grabbing Maduro. You have Greenland. You have, all the countless things that have been going on, and that drives gold even higher. And then you basically have a catch-up trade with silver, which we just see pretty much every single time in this cycle, where if
Yep.
gold goes up by 60%, at the end of the cycle, silver would have gone up 200%.
Right.
And so I think that's really the main driver of what's happening with the price. And so that said, understanding that, when can that stop? It can, but I think the probability of us having less geopolitical risk and more certainty in 2026 is very, very low, especially
You'll
how
take
things
the
have
under on
started
that
off.
too. Yeah.
And so that's why I think there's fundamental tailwind for the precious metals. And then again, you combine that with a chart where the trend is your friend. I would not be surprised, especially gold, silver maybe, but gold especially. I would be very surprised if it ends 2026 lower in nominal terms than where it started. But I'd let the chart make my decision. So,
Okay.
if once that trend goes in the other way, then I'd probably take off some of the position. I'd never sell everything because I always want to own some gold,
Right.
but I may kind of trade around that in a more strategic fashion.
Yeah. Okay. Totally get it. Thank you. I think the only factor I'd add to what you talked about there is just what's going on with supply right now, especially with
Mm,
silver.
yeah.
That is a different factor this time around than we've seen in past cycles, where supply is getting really tight. And I think a factor with that kind of speaks to your point about both geopolitical risk and or geopolitical tensions and counterparty risk, where people are now saying, "Hey, look, we're realizing this is a more essential element than maybe we were paying
Hmm.
attention to before, and we want it, and we want to hold it ourselves." And
Yep.
so I interview regularly, and I just did a few hours ago, Andy Scheckman, who is precious metals, longtime precious metals dealer. So he's got his finger on the pulse of what's happening with the physical flows of the metals, and he's saying that we are just seeing record monthly. Um, uh, what do you call it? At the end of the futures contract, people stand for delivery. And he's
Mm,
saying we're seeing record amounts of withdrawals from the system by all these futures contract holders who were standing for delivery, where in the past they were just settling in cash.
yeah.
And they're of such a size, um, and they don't really in such deep pockets that they're not really using margin, that he suspects that they've got to be sovereign entities, that these are actually countries that are stepping in to, increase their strategic reserves. And what's interesting is in the past, to kind of cool off, the price mania, the CME would increase margins up until the point where, costs be prohibitively expensive to transact,
Right.
and then that would cool off all the bidding. Since these guys don't really use margin, they're just shrugging it off. So, how long this will last, that's to me, that's a key question. Is this something that's going to continue for a long time, or will the supply chain heal and whatnot? I don't know. That's a risk there, but it's an additional factor to what you're talking about, and I think it plays into those same trends. Speaking of silver, I just got to ask you this because I heard you mention this on your program, George, and it really surprised me. And look, you do a great job of what you were talking about earlier of, hey, just do the analysis, right? It's one of the things I really appreciate about you is you will make a statement and then you will go back and say, okay, well, look, let me tell you why I'm making the statement. I pulled the data. Everybody thinks this is the correlation. It's not. Let me show you
Yeah.
why. Um, so you're great about that, but you're also just very transparent, not just with your thinking, but about when you get things right or when you get caught by surprise. And I believe I heard you say, I missed the silver run up.
Oh
I
yeah.
didn't own silver. And I
Yeah.
was a little bit shocked by that because I figured you were a guy who had his finger, his hands in the precious metals to some extent at all times. So did I hear right? And if so, just
Yeah.
just tell me why.
Yeah. So I played it with an outsized position in gold and then the gold miners.
Okay. I mean, which have
So
done well. So it's not like you made a bad trade. Yeah.
yeah, but I sold out of the miners a couple months ago, and I just played that for disclosure. I just played that with the GDXJ. So I was hesitant with silver because of the industrial component.
Hmm.
And when you look, you're sure you got supply side issues, but you could have some serious demand side issues as well if the
Sure.
economy slows down. And so I looked at that, and that was why I didn't pull the trigger on silver, and I preferred to play it just through gold and the gold miners as far as that catch-up trade. Because usually you see gold go first, then you see the
Right.
gold miners, and you see silver, which is exactly what has happened. And that's really why I missed it. I should have done a better job of reading the charts and just relying on history as a guide. And usually, if you've had a cycle play out a certain way 9 out of 10 times, just like with interest rates, or just like when the Fed cuts and the stuff hits the fan, there's no guarantees, but there's just a higher probability, and you should be playing that probability. Now, to be fair, I did get in on silver. I bought. I'd have to look at I've got a log in Rebel Capitalist Pro when I do trade alerts for my portfolio. It was maybe 3 weeks ago or so I bought silver.
Okay.
So on that, I'm probably up, I don't know, maybe 15% or so because it's
I was going
moved
to
so
say, yeah.
much.
Yeah. Especially if you bought after it corrected, which was probably
That's
about
what I
that.
did. As soon as I
Yeah.
saw the breakout and it corrects a bit, then I think, if my memory serves me right, that's where I went ahead and bought. And so I've made a little bit of money on it, but nowhere near as much as I've made on gold, and nowhere near as much as I have made on the gold miners.
Gold miners. Let me show you something. Just when you were talking, you made me think about this. These are charts I pulled today. Um, Here is a chart of gold versus the gold miners. And
Mm,
this chart's a
great.
little bit hard to read, but the yellow line here up on top, that is GDX, that's
Okay.
gold miner, major gold miner
Yeah.
ETF.
Yeah.
And then the green line is gold. And first off,
Mm,
you can just, this is over the past 12 months, and you can see first they just crushed the S&P, right?
yeah. Yeah.
So all precious metals owners can pat themselves on the back. But here the gold miners have performed their historic role of being a levered play on the price of gold.
Right.
Right. Now, I have heard some people say, boy, I actually thought they'd have done even better. So maybe the miners still have a little bit more of a catch-up role to play, but, they've pretty much been 2x. They've returned about 2x what the metal has done in that time frame. Let me compare that to this. Same chart, silver miners. This is the SIL ETF versus
Mm.
the price of silver. Over the past year, look at this. Their return is about the same.
Oh, so the miners haven't moved near as much as they should.
Exactly. Or the metal has run way further than it should, and it
Yeah,
could have a
right.
big violent correction. But just assuming that silver kind of sustains here or goes even higher, to me, this seems like a coiled spring potentially here, where the silver miners, to fulfill their true role of being a levered play on the metal here, they should have a fairly dramatic leg up again if the silver price sustains around these levels.
Yeah. What I would want to do if I was going to make that player consider that is I would want to go back and look at past cycles and see how long they usually run.
Hmm.
And then compare that to this cycle and to see if we're kind of long in the tooth or if we're typically in inning 3 or 4. And based on that, I would, and then also too, I'd want to look at a chart. I'd want to kind of try to time it. But if I'm going to do that, I'm gonna have a hair trigger on hitting the bid in case I'm wrong,
Meaning on
because
the sell button, yeah.
yeah, because that as your viewers know that's risk. That's a speculative play for sure.
It's
And
absolutely a speculative play.
yeah, yeah. So, I might do that with 1 or 2% of the portfolio, but I think where retail kind of misses the boat on that one is they do it with like 20 or 30% of their
Yeah,
portfolio. And that's when they can't sleep at night. And when you can't sleep at night, you make bad decisions.
right.
And
Well,
if I'm going to do a shout out, I'd like to do a shout out to Marty Zweig, his rules of investing. I think I mentioned that last time,
you did.
and I just cannot recommend that enough. That's something that he did in, I believe, 1990, and it's just priceless information. It's really proven itself over time.
All right. Well, look, so, that's the precious metals. Sounds like you think the trend is still favorable. So, you are playing them with the positions that you're in. But of course, it shouldn't be all your portfolio, as you just said. What are some of the other themes or specific assets that have your attention coming here into 2026, given this type of year that you see ahead, which could see greater volatility in the markets? I think you said your base case is the markets might be down 5 or 10% by the end of the year. And it seems like you think the economy is not going to perform all that great.
Mhm.
And then, of course, there's a lot of wild card factor in there, given the volatility and other things that we talked about. So, what else is on your slate for a year that looks like this one?
In that environment, you most likely get a bull steepener. And so I think it's being boring, but I think that was my favorite trade last time, which actually worked well because I think last time we talked, it was maybe at low 50s or something like that. And now it's, I think, around 65, 67. So that's been a good one for me as well. That one's a little tricky though, because you've got to buy futures. You've got to go long the 2-year treasury and short the 10-year treasury. And because of the duration mismatch, you've got to buy a lot more of the 2-year than you do of the 10-year. So you've got to, that might not be just for the average Joe and Jane. But that's probably what I like the best because if you look at a chart of the twos, tens spread, and you can just pull up a Fred chart of that, you
Yeah.
see that when we go through these cycles, it plays out just the exact same way every single time. And again, it doesn't necessarily mean that it's going to play out the same way this time, but it's just a matter of probabilities. And you
Okay.
see the ace.
Sorry to interrupt, but just so folks here, because we didn't define it, bull steepener, that's basically where your yield curve is
Steepening.
expanding, but it's
Yep,
because the short end is coming down.
correct.
Yeah.
That's correct.
Yeah.
But what I really like about it, Adam, is let's just say that Lutnick is right. And let's say Lutnick is right, and we do have 6% GDP growth because of the AI productivity gains, because of fiscal and all those things that you talked about
Yep.
at the beginning of the conversation, then you're likely going to have a steepener. But it's not going to be a bull steepener, it's going to be a bear steepener, which is the opposite, where the long end goes up
Right.
more than the front end.
And that's
But it
really
doesn't.
because that's the bond vigilantes saying, look, we're worried, you got to pay us more, right? It's not a sign of necessarily confidence in the economy.
No, I don't know. It's the opposite
Oh, okay.
because it's growth and inflation expectations increasing.
Okay. Yep. You're
So
sorry, you're
it's
right.
growth
But
and
again,
inflation.
they're demanding a higher price because of that inflation.
Yeah, because they've got alternatives for their money that where the risk reward makes more sense.
Sense. Yeah.
So especially the big banks, they're going to buy fewer treasuries or maybe even sell some because they would much prefer to lend into the real economy because there's more opportunity there. And again, that risk reward makes sense. And therefore, interest rates at the long end go up. And that's usually why they kind of trade alongside of nominal GDP, which is kind of growth and inflation expectations. So if the economy booms and Lutnick's right, then great. You get a steepener. You win. It's just a bear steepener. And if George Gammon is right and the economy kind of grinds to a halt, maybe we even get a recession, maybe the labor market deteriorates further, and we do have a down year in the S&P 500, which is definitely a tailwind to aggregate demand, or excuse me, a headwind to aggregate demand, then most likely there's going to be more Fed rate cuts than are priced into the market right now. And you're going to see that reflected in the 2-year Treasury going down a lot faster than the 10-year Treasury. And we're talking about yields.
Yeah.
And that would be the bull steepener. So the way you lose on that is if you get a flattener. And if you look at that chart that I'm talking about, that Fred chart of the twos and tens, maybe your editor can throw that up. And
Okay.
you
Yep.
look at past cycles where we go into a Fed rate cutting cycle. And usually what happens is you start from an inversion and then you usually top out at plus 200 basis points or so. And just to reiterate, right now we're at maybe 65 or 67 basis points. So when we go back to the asymmetry that you want in your portfolio, you've got a lot more upside there than you do downside with, even if we get a flattener, the chances that we go back to inverted, probably pretty low. So
Mhm.
that would be your downside of, let's say, 65 basis points, and your upside is maybe another 150 or even more. And usually what happens in these cycles, Adam, and because if your editor threw up that twos and tens chart, you'll see just the thing go parabolic. And I'm talking about the spread. And that's usually because you get the bull steepener because the Fed's dropping rates. And then what happens is you come out of the recession and then you get the bear steepener. So you get the bull steepener first, and then you get the
Yeah.
bear steepener. And that's usually why you go from an inversion all the way up to like a positive 200 or 250 basis points.
Okay. So I think you mentioned that at the start you referred to it as a bull steepener trade, but it's really just a steepener trade.
That's correct.
Yeah.
That's
Yeah.
correct.
Okay. All right. Fascinating. Well, folks, there you got something to go check out. All right. So, George, it's always great talking to you. I see here that we've run over the hour here.
Yeah.
Let me ask you this just as we start to wrap up here. Um, is there you know, is there a trend or a concern or an opportunity that is just burning brightly on your radar that I just haven't been intelligent enough to
Yeah.
ask you about yet?
Yeah. Uranium. And I know that will be relevant to a lot of your viewers because they're interested in commodities.
Sure.
And if I'm just using a proxy for the Sprott Fund or the Sprott Physical Trust,
Yep.
and I think it's what is that, Adam? SRUUF.
Yeah, exactly. Yep.
Okay.
SRUUF.
And I know that because I just bought some. And so if you zoom out and look like a 5-year chart, and then you look at a 1-year chart, you see a bit of a breakout. And going back to the trend is your friend, you're starting to see higher highs and higher lows. And we all know the fundamental story for uranium. I mean, over the long run, you 5, 10 years, you've got a super, super, super bullish fundamental story. And it seems like the chart now is starting to play ball. So, full disclosure, I just took a long position in that Sprott Uranium Trust, and that's probably my favorite trade. I think you could see like the speculative capital go from silver and really start funneling into uranium. We'll have to see. Just like I think the crypto speculative capital went from crypto into silver. And that's one of the reasons why you've seen such a dramatic move over there as well. You could see the same thing with uranium. But bottom line, fundamentals look great and the chart looks great. So I just took a long position there.
All right. Just FYI, in Trump's address at Davos, he did really emphasize that the U.S. is going big into nuclear. So for what it's worth, you know,
Yeah,
the
I mean, you've got a lot
administration,
of political tailwind as well.
yeah. Um, I'm curious, are your current thoughts about playing that the nuclear opportunity? Are you going to basically stick with the actual, source itself, the fuel itself, uranium, or are you looking at any of the other nuclear stocks, right? The Oklos of the world, the people that are actually going to be building the reactors?
I should, but I don't have time.
Okay.
I,
Okay.
I should, but I just don't have time with, it's, what I've got going on with family
Oh, it's an
and
honest answer, which is great. It's the best kind.
yeah,
Yeah.
yeah. But for your viewers, if I'm going to give you some advice, don't do what I do. Don't do what I do, and just do some homework. Even if it's 2 hours a week, and you're going to find better opportunities there with better asymmetry.
Well, look, I'm gonna disagree with some of that, which is I know that you have a, community amongst your followers where they can actually subscribe, and I can't recall what you call it, your inner
This is Rebel
circle.
Capitalist Pro.
Okay, Rebel Capitalist Pro,
Yeah.
um, where like when you do things like take a new position in something like uranium, you're letting everybody know, you're explaining why you're doing the trade. The community can talk about it with you. Okay, well, why are you doing that? And what about this risk and stuff like that? You'll also let people know when you start to sell too. So I definitely think, George, that people who really appreciate your insights and think you've got a good beat on what's going on, that's a great resource for them. So let me get to my wrap up question here,
Sure.
which is for folks that have really enjoyed this conversation and would like to follow you in your work, George, where should they go?
Well, they just follow me on YouTube, or they can follow me on Twitter, or they can just Google Rebel Capitalist Pro, and I'm sure something will come up. But it's not just about me, Adam, and Rebel Capitalist Pro. It's more so that Brent Johnson, our good friend,
Yeah.
is in there. He's one of the pros. And Patrick Seresna from Macro Voices is another one of the pros. He talks about options all the time.
Hmm.
And Chris McIntosh is in there as well. So it's the value far exceeds just little old me. Because I'm probably the amateur in the Rebel Capitalist Pro. So
Uh,
anyway, but that's how people can find me. I appreciate you giving me the opportunity to do a little plug.
no, 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 no. Look, it's you've got a lot of well-deserved fans there, George. I want to make sure they know how to find you. So, George, when I edit this, I will put up the link to your YouTube channels, your X handle, and to Rebel Capitalist Pro. Folks, the
Okay.
links will be in the description below the video as well, so you can go there with the one click. Um, all right, my friend, I can't thank you enough. It's such a pleasure to get a chance to spend a little bit of time with you. I hope we get to see each other in person again this year. I'm sure we will. Probably, I know we always see each other in New Orleans, but hopefully we meet up before then too.
Absolutely.
All right, well, now's the time on the channel we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by John Lodra and Mike Preston. Gentlemen, thanks so much for joining us. Mike, why don't we start with you? Any key reactions there to the great discussion with George?
It's really cool to watch you and George talk today. John and I have been longtime followers of George. First time I was able to meet him, and it was a pleasure, and it was an honor. Just a couple of high points here I'd like to point out. George talked a lot about the labor market and the labor market likely being softer than the numbers have said that they are. In fact, you guys were talking about how job growth might have been overstated by 60,000 last year.
Yeah.
And if it
And by
really
the way,
was
not our
overstated,
opinion, the Fed's. That's Jerome Powell's out of his mouth.
which is crazy, which means that, jobs have actually been flat to maybe down, negative. And, the big theme here is you can't have GDP growth and flat, certainly not negative job growth. So jobs have to be growing robustly to have robust GDP growth. So it's a real concern that if jobs are weaker than we thought, or even if they weaken from here, then it's going to be a big negative for the stock market, certainly at these valuations. And George rightly points out that stock markets are ridiculously overvalued. The macro is really bad, but rightfully so, he says, don't short the S&P. A lot of people that have tried it over the years have learned the hard way. It's really literally near impossible to short the S&P 500, particularly with, as Mike Green says, the giant mindless robot. And you guys talked about the mindless robots switching from buy mode to sell mode at some point, but the problem is that nobody knows when that's going to happen. So it will happen, particularly during this with this backdrop of macro overvaluation and the Fed having to be all in all the time intervening. We just don't know what the catalyst is going to be. Everybody wants to know. Nobody knows.
Yeah. Hey,
But
Mike, real quick, let me just remind viewers. So, the guy who's been closest to tracking the whole passive capital flow as the giant mindless robot is Mike Green, which we mentioned several times. Mike has uh, assured me that if and when his data tells him that the passive flow is starting to break down, that obviously after he, tells his own clients that, he will then come on Thoughtful Money and let us know. So just rest somewhat assured that we'll give you the earliest warning of changing dynamics to the passive capital flow if and when they start to occur.
I've got no doubt that the giant mindless robot starts selling when it feels enough pain. And George said that he had a lunch or a talk with Mike, and they were talking about some level that they think that that would happen. I've got no doubt that the giant mindless robot will turn around and do the opposite at some level. Nobody knows what that is, but the whole market is really just made up of psychological human beings. And when they feel pain for the first time in a long time and it's not immediately rescued, they'll start selling. So that's the big risk. So George talked about really if he was an analyst, what would he say is the upside here? Maybe 5, 10, or 15%. What's the downside? I don't think he said this, but if you look at the macro, if you look at valuations, I think the downside could be 60 to 70% because based on statistics that are really meaningful in terms of what future returns are likely to be, we're three times the value of what the S&P would have to be to have average valuation or average returns of 8 to 10%. So, you might literally have downside of 60 or 70% here and upside of 10 or 15%. And I kind of agree with that we might have a blow off top and it might give us 10 or 15%. But then if we lose 50, 60, 70%, what was it for? It's just a move that really kind of destroys everybody. So that's how dangerous it is right now. And I guess I'll just finish with a couple things here. He thought that in 2026, it really depends upon what the Fed and central planners do. I'm not sure I completely agree. I think that gives them more power than they really deserve, even though they've been the only name in the game for 15 years. I really think we're getting long in the tooth of this thing, and really long in the fourth turning that we're living through here. And I think we're really deep in it. We haven't seen the crisis or the climax of the fourth turning yet. And the crisis, in my mind, is when the stock market tops and falls very hard, and the climax comes a couple of years later. I think and I believe that the things that we're seeing, plus, the relentless up action in the market says that we're closer to the peak of the market. I wouldn't be surprised to see that happen this year and not a big down move. In the meantime, it's all about looking at our indicators. Our indicators are really strongly positive right now, and thus we're relatively bullish. Not largely bullish because of our viewpoint and our hedged risk approach, but our indicators are bullish. Just today, the Russell 2000, if you look at ticker symbol IWM, the ETF that tracks it, it hit a new high. The S&P had a pretty big reversal. We'll see if the S&P makes a new high in the coming days. If that happens, we could have a little bit of a run here.
Hmm.
I think all that's going to do is suck people in, and that's what you have to be worried about. So I'll pause there, but I thought it was a good talk, and it's never a dull moment in the markets here. I think that we're in a very critical time.
Yeah. Um, well, the concerns about valuations and how far this could fall. And Mike, you've done a good job over the past many videos of doing the math to explain why a 2/3 drop in the market. You can make a pretty credible argument that would be much closer to fair value for the market. And of course, markets overcorrect on a correction too, so it could go even lower, as unimaginable as that may sound to people. The problem is those are bad timing indicators. And as you said, we're starting to see breadth improve. And there's a whole bunch of other things that may be coming into the mix. And I listed a whole bunch of them, kind of parroting what the administration is putting out there. It's just the kind of thing, as George said, like you don't want to be standing in front of this shorting. And you don't even necessarily want to be just going all to cash, right? We've had people that did that several years ago, sometimes 5 years ago, 10 years ago for these same concerns. And then they've been missing, all the appreciation since. So, part of it is a little bit about trading the market, or an important part of it is trading the market you have, not the market you think we should have, but still, keeping a wary eye out for the fact that, at some point in time, natural market forces may gain the upper hand. And so you want to make sure that you can be nimble and protect yourself when that does eventually happen. John, anything to add to what Mike said about the discussion with George there?
I would just like to give props to George and his hat. We've been quite critical of the Fed and the interventions, and what says it more loudly than the Fed hat that George was wearing. So I want to give props to that. Of course, we don't really think the Fed is going away, but it would be nice to have something a little less politicized and truly independent. But we can all dream a bit, right? No, I think Mike covered George's comments, and I'll just add that we as Mike said, we've valued his perspective on a lot of things for a number of years. So great to connect with him, chat offline with him a little bit. One thing I want to talk about. So here we are, 2/3 through the first month of the new year, and in some ways, things have remained the same. Some of the very strong themes from last year have continued. Yet in other ways, things have dramatically changed in terms of what's moving in the market. So as much as the kind of the great, giant mindless robot kind of theme is very much in play, I would caution folks to not interpret that to mean that there's not value in being selective and tactical, because we certainly see that there is. And let me just share a quick graphic that I whipped together here, just to kind of talk about what I mean. This is actually just year-to-date returns for various glimpses of the market and different asset classes through yesterday, close of business yesterday, January 20th. And so let's start with the broad market. So first off, notice this: the S&P 500 through yesterday was actually down on the year. Okay,
yeah, it's the laggard. Yeah,
and why is that? Some of the themes like the Mag 7, the AI hyperscalers, those stocks have really struggled on a relative basis so far this year. And you see that, for example, just comparing the S&P 500, which is a capitalization weighted index. That index is, I want to say, something like the top 10 names, I think, are over 40% of the, approaching 50%. I may have that wrong, but point being is a very small cohort of stocks. These large hyperscalers have an undue influence on the moves of that index. All well and good when they're going up, but the opposite is the case when they're going down. And that's borne by comparing the equal weighted S&P 500 index. That was up to 2.3%, more or less, year to date. Big outperformance there. That's a new development so far this year, new trend. Look at Mike talked about the Russell 2000. That's up through yesterday, over 6%. Versus again, I kept the Nasdaq off here, but the Nasdaq was down about 1% through yesterday. So a lot of these tech names have really started to struggle. Let's look at precious metals. Of course, the story continues to be that precious metals and commodities have continued to do well, but especially precious metals. But look at broad commodities; they've done so far very well. It's a trend that has continued from the latter part of last year's. Bitcoin has struggled this year. So-called digital gold has really struggled, not only so far this year, but in much of the rally of the end of last year. That's a notable divergence that continues. Precious metals, even just today, have outperformed Bitcoin. Look at the sectors. What do you see at the bottom of the barrel? You see things like technology, you see things like financial, communications. These are the sectors that largely outperformed last year. and they are bottom of the barrel now. And we use systematic tools to kind of tease out these trends. So, for example, we dumped our financial sector allocation, I think either I want to say sometime in November, and rotated into global mining and metal stocks. And those are the kinds of things that have done well, and energy, for example. A lot of basic materials type stuff. So there's definitely really textured movements underneath the surface that one would otherwise miss if they were just kind of, adopting this, hey, the passive flows, all you need to do is buy an S&P 500 index fund. That it's quite a bit more texture than that, and we have a toolkit to hopefully help tease that out. So I just want to kind of comment on that.
Well,
The
so
other
let
thing
me,
I would just talk about. Oh, go ahead, Adam. Let's pause there.
well, yeah, let me just ask you a question there. So let's assume that the tech growth sector kind of just remains anemic in terms of its performance in 2026.
Mhm.
Can the rest of the market pull the S&P up to another, attractive double-digit year, or does it need growth now because that has become such a massive share of the market?
Well, the cap weighted index would certainly struggle to make, meaningful new highs if that cohort was struggling and didn't meet its earning targets, for example, which are very rich for the year ahead.
Right. Because I think the
But that
Nasdaq,
doesn't mean.
you said those 10 stocks were like 40+% of the S&P. I think it's like 60 to 70% of the Nasdaq, right?
Yep. Yep. Very, very hard to have capitalization weighted indices make meaningful new highs if those stocks are starting to stall out. But that doesn't mean you have to be stuck in those capitalization weighted stocks. You can pick sectors. You can be in
Right.
smaller caps. You can be in some of the equal weighted.
Yeah.
That
The,
can make a
the
big difference.
individual active investor can find their pockets of opportunity, but I'm just trying to underscore this is kind of the deal with the devil you make when you allow uh, a small number of companies to become that dominant. Is it's great when they're doing well, they pull everything up with them,
Mhm.
right? And people that are in general indices, are really happy for that. But when they struggle, all of a sudden you find, Jesus, it's hard to get return anywhere if you're just staying in these sort of standard, indices, which of course a lot of people's retirement accounts are in per se.
Yep, absolutely. The other couple quick comments I'll make. George talked about his take on where the bond market will likely be. He's calling for a bull steepener, but more broadly, he talked about playing this through a steepener trade where
Mhm.
you would go long the 2 year Treasury on the presumption that short-term rates will fall faster or rise less than longer term rates, depending on what scenario we have for an
Mhm.
economics scenario. I think that's a very plausible scenario. I think we would agree with George that we would take the under on the pretty eye-popping administration projections of what GDP is going to be in the year ahead. There was one point I know they were talking about double digits, which is just absurd. I think it's probably no point in history where we've seen that kind of growth. So yeah, we would take the under, meaning that probably more sluggish economic growth than what the administration is talking about. And that's not a political statement. It's a statement about where we are in the economic cycle as much as anything. Um, and precious metals, we agree that the trend is your friend. As bullish as we have been and our clients have benefited, we think that longer term, precious metal prices are probably going quite a bit higher. And this is a statement about, again, the regime that we're in. And even the folks like Ray Dalio are talking about, a complete, change of regime here in terms of what central banks, view as adequate collateral in terms of the kinds of assets they want to hold. That doesn't mean, however, that precious metals can't see a near-term pullback, and we think that's quite a likely scenario. So while we think the trend is your friend, absolutely, our clients who are real people that have lives and wishes and dreams and needs, it's a perfect time to think about cashing in some chips here on this strong move. Many of our clients, I just talked to a client today that had a tripling in a silver investment that we helped them get into, and we just took out all the profits, and they still got a nice position there to keep riding, but they're going to do some other things with that money,
Mhm.
live their lives, use it to travel, use it to improve their home. These are what it's for real people.
Hey, so John, so there's rebalancing, right? And taking gains off the table as you have them, some gains off the table as you have them, which is just part of standard, you know, good stewardship of portfolios. Um, but to your point about the trend being your friend, when do you think about de-risking? Do you think about de-risking as it continues to rise and just saying, hey, this is really getting extended? Or do you actually wait until you start seeing a breakdown in the trend before you start
Yeah.
de-risking?
So there even within a nice tidy uptrend, there can be extremes. So let me just pull up a chart of silver. I'm going to pull up a chart using SLV, which is an ETF, and I know Mike can probably do his usual kind of more comprehensive review of the precious metals market. But there are times where an uptrend can get a little overheated. And if you can see this chart, this is a daily chart of SLV. Let me just zoom out. This is a monthly chart. I mean, and we probably should be looking at this as a log chart, not a linear chart, but
Yeah.
which would kind of make this extreme look a little less extreme. There's a good reason to do it that way, but I won't get into that. But zooming in on a daily chart, there's several lines here. I just want to give viewers just a quick legend here. This green line here is the 50-day moving average. This kind of light purple line or light blue line is the 21-day moving average. It just and then this red line is what's called the Bollinger Band. It's two standard deviations above and below the 50-day moving average. We've seen silver walking up this Bollinger Band at an increasingly steep angle. That usually suggests that you're gonna see a snapback in the short term. It can walk along that band for a while, but you get some sharp pullbacks along the way, like this and this. It would not surprise us at all to see this pullback even to just the 21-day moving average. So that's going from in this chart 84 down to 73. That's a pretty decent pullback, right? And so what do we do in those kinds of scenarios? Well, certainly trimming position size. We did some rebalancing yesterday to trim some position size, but also hedges. We have had hedges on our silver as well as our gold mining stocks. And those hedges can take the sting out of these short-term pullbacks and give us the opportunity to reset those hedges so that we can kind of hopefully continue to ride that trend higher. It's a very dynamic thing that we do it with a very hands-on approach. But those are the kinds of things that even a very solid and healthy uptrend can, in the short term, get stretched to the upside and increase the probability of near-term snapbacks where you want to be a little cautious.
Okay. Mike, we'll come to you in just a sec and let you do the precious metals wrap up because they continue to be doing great still. Gold earlier today, it hit an all-time high, and silver is flirting with it. So right now, John, from New Harbor's perspective, what asset classes or strategies are you guys finding most attractive right now, given the market environment?
Yep. Well, somewhat not surprisingly, the areas that I showed earlier on in the graphic of year-to-date performers, we're heavily into a lot of those, and it's not because we're looking backwards. We actually rotated into a lot of those towards the end of last quarter, let's say, of last year. And why is that? Is because we saw systematic relative strength improvements. For example, we saw financials starting to lag dramatically compared to, for example, healthcare and energy and basic materials. So we rotated into this, and we think those will likely have continued move to run and room to run. And the valuations of those sectors are far better than, for example, the tech stocks. And so we like basic materials. We like commodities, non-dollar denominated assets, both bonds and stocks. We have an increasing nearly half of our equity exposure. We have about 47 and change percent equity exposure right now, still underweight equities, but nearly half of that is in non-US equities denominated in local currencies. We have a targeted allocation, for example, to Latin America, which has been one of the strongest, international sectors. Emerging markets have done very well. New highs even in developed international markets. So that's where we, generally speaking, we're tilted more to international stocks rather than U.S. stocks. We still, again, precious metals. We have broad-based commodity exposure. We think the base commodities, base metals, and things like that have more room to run. They've been very strong of late, and these are kinds of things that certainly you would expect to do well in the kind of a possible inflationary environment with stimulus and fiscal and otherwise. So that's where we see things right now.
Okay. And in terms of those sectors, healthcare, base metals, et cetera, How are you tending to play them? Are you playing them via sort of a sector ETF, or are you actually
Yep.
picking individual companies?
Yep, sector ETFs. We found that a macro sector rotation approach works really nicely. You avoid a lot of single company risk, and and this certainly in these kind of index-driven markets, oftentimes it's what's happening in the sector that drives the move, not the individual company kind of news or whatever. So our play is predominantly through sector and geographic ETFs.
Okay. And I want to ask you guys about natural gas because it's just going bananas the day that we're talking here.
Hmm.
Um, and I think largely what's driving this is they're suddenly expecting colder weather in the US than they were before.
Yeah.
I don't know how you can have your expectations change that dramatically, but
Yeah.
maybe you guys have insight on that. But
I'll tell you about that, Adam. I'll just tell you the first decade of my career, I was in the energy industry before making a mission-driven career change. And one of the last companies I worked for was Enron. People know Enron, infamous Enron. And so I worked in close collaboration with the energy trading desk. And every week, the AGA, the American Gas Association, will put out their what they call their weekly storage report. This is the report of inventories of gas storage. Many people don't know that a lot of to meet peak demands, there are storage facilities, literally, and oftentimes they're underground caverns that they pump with natural gas just to put it in storage so that they can easily and quickly release that gas to meet demands. So that storage report was like one of the most closely watched things on the trading desk, and it could move things in an instant. Though, and what drives those short term reports? The weather. So the fact that it's no surprise we have some pretty cold weather forecasts across a big part of our country. So you're going to see some crazy stuff. In many ways, natural gas is an uninvestable commodity, in my opinion, for everyday investors. It's so volatile and it's so driven by short term weather forecasts that it's not a supply and demand thing from a big picture structural thing.
okay. Well, I just want to show people visually how crazy today is. So if you can see my chart here, you can see right here at the very end on the right-hand side, you can see the dramatic, I think right now it's about a 27% increase in just today on the price of natural gas. And this is what, like almost a 2-year chart. You can see nowhere in this history did gas move anywhere nearly as much in a 1-day basis as it has right now. So yeah, this can be a kingmaker or a widowmaker, right? I'm sure there are some traders today who are doing, they're just making complete bank, but I'm pretty sure there are going to be some guys carried out on stretchers today too from this.
Yep, and there's been some spectacular hedge fund blowups in this commodity itself. Amaranth Advisors, you might remember in the early 2000s, I think it was, blew up on a bad natural gas bet. It's a very, very tricky commodity to invest in.
Yeah. All right. But if you're increasing your exposure to energy there at New Harbor, I'm sure this is just one additional helpful development along the way, although who knows how long-lived this one will be. Mike, why don't we come to you and you can give a quick recap of what's going on with the precious metals, and then we'll wrap up here for folks. But the momentum generally continues here, right?
Sure, I think you guys covered it pretty well. George talked about being in the gold trade, and he just bought silver, I guess, not too long ago. But absolutely, the trend has been your friend, and he's a big trend guy, and I can't agree more. As John said in the video, when he showed in on the video the chart a little while ago, we've been walking up along the Bollinger Band, and that often happens in super strong markets, and you don't want to short that because you just don't know how far it's going to go. But you do
Hmm.
want to be careful if you're getting overexposed to take profits on the way up. And so all of that is to say that I can't tell where the top is here. I've learned a long time ago not to try to call the top, but we're getting really close to big round numbers. 100 on silver and 5,000 on gold. And I guess I'll show the chart because I always show the chart. I know John just showed it, but I'll bring it up here because I know that some people are going to be talking about today being, potentially a key reversal day. And I don't think I'd read too much into it. But here's silver. Silver hit a high yesterday, and then actually had a pretty good recovery late in the day, but it sold off, and it's got a couple red bars. So some people might be concerned about that. Gold was a little bit more a little more extreme.
Yeah. Can I just share something? So I was recording earlier
Sure.
today with Andy Scheckman, and somebody in the chat said, "Yeah, it looks like silver's stuck between 93 and $94 an ounce." It's just like, are
Oh
you
my
kidding
goodness.
me? Like it just hit them the past week, and these are such extreme numbers relative to its price action. Like, how can you be bitching that it's stuck already?
It's doubled, Adam, in a month or two. It's
Oh, I
doubled.
know. I mean, it's just
So, but
I'm like,
that's, that's the Wall Street bets crowd. Everyone wants everything instantly. But th this trend is incredibly strong. I don't have the Bollinger Bands on here, but look at the 21-day moving average. It's well above the 21-day. Every little dip was immediately bought. We're sitting here. This is the SLV ETF at 84. Spot silver somewhere around 91, 92. So who knows? We've got a little bit of an uphammer, but also 2 days of red. Your guess is as good as mine. I wouldn't want to fight this trend. I wouldn't want to short this trend. Let's put it that way. And that was silver. Here's gold. Gold was up like $90 an ounce this morning, and then
yeah,
it pulled off, and I think it ended up around 50 or 60. But this chart is beautiful as well. Big base breakout where this line is here. We broke out a couple days, went sideways and broke out strong again. I'm thinking that the trend is still up, just like George. I'm agreeing completely with George, bottom line. I think you talked a little bit about the silver stocks not doing better. For instance, SLV. SLV's done fine, right? But
you
it
mean
hasn't had
SIL?
I'm sorry, SIL hasn't had the expansion that silver has had, or SILJ, the juniors, but they're still doing great. They've had some pretty big reversals here today. The only time will tell if that matters. But this is SILJ. This line, I can actually take that line off, but that was there because it's a fairly important level that we've broken through and we're hanging out. But we've had breakout after breakout after breakout, and each one has just been followed by consolidation and a higher. So I wouldn't want to stand in front of that train, but I also wouldn't want to expose my whole portfolio to it. So I'm agreeing with what John said earlier, trim on the way up. But still, I think and I know it's getting a little bit overheated, but I still think the trend is up, and I wouldn't be expecting a top imminently.
Okay. Do you?
Adam, one thing I
Yeah.
wanted to interject here on the silver miners, and we've talked a lot about this internally here. There are very few silver miners that are pure play silver miners.
Right.
In fact, oftentimes the silver is just kind of one of many byproducts of their mining. So it's not entirely surprising that you'd see the silver miner cohort as a whole not kind of track as levered to the price of silver as, for example, gold miners would to gold. Just something, textually that I think is important to understand in that sector.
Yeah, I talked about this earlier today with Andy. Yeah, a lot of the companies that are in there, even though they're in the silver mining ETF, they mine more gold than silver, or they mine more, base metals than silver, because it's so hard to find a pure silver mine these days. So yeah, it's important food to keep in mind for thought. Um, all right. Well, Mike, I assume what you'd probably like to see here at some point is some consolidation, right? Some sideways trading to kind of take the froth off, let the moving averages catch up to where prices are. Um, don't let me put words in your mouth, but I think you would think that that would be a good sign that you know prices would be more sustainable.
Absolutely. I mean, it's not sustainable for silver to go up $5 or $6 every day, on a base of 80 or 90. The best thing that could happen probably is some consolidation and then a move higher. I've said oftentimes that in big bull markets, you'll see an asset or a group double off of a base. And I pointed out that the gold and silver miners have doubled and even a little bit more off their big base. And I could share some charts, but suffice it to say they've had a double and then some. And then if they would just consolidate here, I think that they could double again, particularly the silver miners over the next handful of months. So I think it could be quite a move. I wouldn't bet everything on it, but yeah, if we could see some consolidation, it would be really good. Okay, and
Okay.
one last thing I'd like to say before I wrap up is that, and John alluded to some of this earlier, we're starting to see a number of sectors, high relative sectors, really break out. And I could share just a couple quick charts, and then we can pause. So just sharing, like for instance, Latin America, a piece that's in our portfolio John talked about. Look at that. Latin America has just been a monster mover. And then industrials, another key piece that we have is in there. Pick, metals and mining. boom, just really taking off. Industrials doing well. And healthcare, big update today. And we talked about the equal weight S&P, big update today. So relative strength analysis is starting to work and the strong sectors are getting stronger. So we might really be seeing a broadening of the market that could make us launch a little bit higher here. We'll see. Um, and that could take the miners higher too. We could have a situation where everything goes up, a blow off, so to speak, and then and then falls. So to me, it looks like the tailwind is there for everything, for all of that to happen.
All right. Well, whether it does or it doesn't, folks, we'll have Mike and John in here week in and week out going forward across the rest of the year to be giving us an audible update every week so we can stay, very close to the pulse of what's going on. Gentlemen, thank you so much for joining me here again. John, I'll punt it back to you just real quick. Because you guys are talking to so many people, you've got a great pulse of the heartbeat of just the average investor, especially the average investor or the average viewer of this channel and what they care about. I've got to imagine you guys are getting requests with like, okay, my precious metals position has tripled. What should I be doing here? What else is on people's minds right now?
Yeah, well, certainly the headlines, whether it's we're going to take over this country or that country,
Hmm.
people, and yesterday, like even yesterday, the markets were down pretty healthily, stock and bond markets. Thankfully, our client portfolios were actually barely changed on the day, and we had a couple of clients reach out to us and say, "Wow, I was actually surprised. I was expecting to see a bloodbath." And don't get me wrong, there are days where our portfolios underperform and things like that. So it's not a victory lap, but people are very. I raise that just to say that people are a little bit elevated attention to the news headlines, and that could be a good or a bad thing. Usually a bad thing when it comes to investing because
Well, if
these
it's making them
headlines.
emotional, their decision
Yeah,
making, it's a
exactly.
bad thing.
Exactly. And one day is usually not gonna, make a trend and that kind of thing. So we're having some, conversations like that, settling people down. We did a pretty good job not, we had good gains in client portfolios last year, but we were able to kind of mitigate a lot of realized gains. So we didn't have big, and we very intentionally pushed those off to this year. We thought that this year for a lot of people would be a better year to book some gains. And so we're actually having some of those thoughtful conversations now about, realizing some of those gains that we
Hmm.
help clients defer into this year. What else? I mean, we always get a smattering of people that, hey, reached a new year. I'm another year older, or this is the year I'm going to retire. What do I need to start to think about? So we do a lot of financial planning stuff that covers all the bases you can imagine, well beyond just the investment tactics. But yeah, those are things that come to mind.
Okay. Well, let me just again underscore what you just said there, which is, last couple of months we were encouraging people to get in touch with their advisors to make sure they handle all their end of year planning stuff. Um, I think we said this last week, but very important now that it's the beginning of the year to update your financial plans and your game plan for the year so that you can get all your ducks lined up accordingly now and then spend the rest of the year executing towards your goals as opposed to, you know, the procrastinator who calls you guys up in October and says, "Oh, what should I be doing to maximize my situation for this year?" And you're like, "Well, maybe get a time machine and go back to the beginning of the year." Well, right now you've got the time machine, so use it well.
Absolutely.
All right. All right, gentlemen. Well, thank you so much. Everybody, if you'd like to see George come back on the channel, let's say in Q2 to give us an update, please let him know that by hitting the like button and then clicking on the subscribe button below if you haven't already, as well as that little bell icon right next to it. I want to remind folks who are, still attracted to the precious metals trade that Miles Franklin, Andy Schechtman's firm, is still offering their exclusive offer to the Thoughtful Money audience for buying junk silver from them at very attractively low prices. They started the promotion off at being able to buy junk silver from them at a dollar under spot, given the multiple margin rate hikes at the CME. That was then raised to $1.35 above spot, which is still historically really low premium. And then because they got some more inventory in, they've been able to lower that a little bit. So now the offer is you can buy junk silver from them at just 99 cents above spot. So if you want to learn more about that, maybe take advantage of it, just fill out the very short form at thoughtfulmoney.com/buy gold. And when you fill out that form, Andy and his team will be in touch with you right away. And if you fill out that form, it's not just for the junk silver offer. If you've got other questions about buying, selling, or storing precious metals, they can help you with that too. Lastly, if you would like to get some help in, maybe updating your financial plan, or just how to position your portfolio for 2026, especially if the year looks the way that George thinks it might, highly recommend you get that help from a quality professional financial advisor. If you don't have one or would like a second opinion from one that I think meets the criteria of a good professional financial advisor who takes into account all the macro issues that are discussed on this channel, then consider scheduling a free consultation with one of the advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you'd like to talk to Mike and John themselves. They're at New Harbor Financial. To set up one of those free consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. There's no commitments involved. It's just a service that these firms offer to be as helpful to as many people as possible. John and Mike, gentlemen, thank you so much. Mike, I'll let you have the last word before we close up here.
I really don't have much more to say. I just think it's an exciting time. I think it's late in the game. Be careful out there. If you're not an active trader, just severely reduce your equity. We'll sit on cash. And we'll be doing the play-by-play here every week. And thanks for that opportunity.
All right, well said, Mike. Okay, gentlemen, thanks again for joining me for yet another week. Everybody else, thanks so much for watching.
Based on Fibonacci, it says based on this rally, based on the strength of the pullback, it's going to tell us where the upside targets for gold are. And so we can look forward and look above. Gold has the potential here to run to $3,722, and it can go all the way up to about $4,100. So if we look at that, you can see that's a 20+% move. And this is a very similar thing we saw in 2007, meaning we could see it not only hit this target, but it could become the crowded trade short temporarily, and we see gold blast through and move up to $4,500 or something huge. It could really have a big move at this point.
Analysts project a rally into the $3,700 to $4,100 range, representing a move of over 20% from current levels, similar to the breakouts seen in 2007. Goldman Sachs maintains a base target of $3,700 by year-end and $4,000 by mid-2026, while noting that in extreme scenarios, prices could rise to as high as $4,500 by year-end 2025. Momentum is strong, sentiment is bullish, and key catalysts, such as rate shifts, geopolitics, and safe haven demand, are aligning for a potential breakout ahead. Chris, founder and CIO of thetechnicaltraders.com, recalls that back in 2007, gold was expected to rise by about 20%, but instead it rallied 37% as equities peaked and began to decline. Today, analysts observe a similar setup, with gold forming a classic bull flag pattern and Fibonacci targets projecting gains between $3,722 and $4,100. If momentum builds and the trade becomes crowded, some forecasts suggest gold could even overshoot toward $4,500. Should equities weaken, history indicates gold could surge even more strongly, with silver and mining stocks likely to follow. Traders are watching closely for technical confirmation, particularly a breakout to new highs in ETFs like GLD. Meanwhile, physical gold buyers are steadily accumulating, seeing it as insurance before a significant breakout. Once gold truly takes off, physical supply could become scarce as investors with access keep it locked away. That's why many prefer to stack and store gold now before a potential perfect storm drives demand through the roof and makes it nearly impossible to acquire at any reasonable price. Before we examine the video, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
This type of scenario, gold actually had an upside move, a measured move in 2007, just as the stock market was putting in a significant top, which I think is close to where we're at right now. Gold should have rallied 20%. Not only did it rally 20%, but it blew past it and went up 37%. And so right now we have a very similar chart pattern. Gold, if we flip back to the chart of gold, has this, I love to use Fibonacci extension, Fibonacci theory. If you don't know it, you have to look into it because it's in everything in the universe. But more or less, it tells us where the upside targets are. Now, based on Fibonacci, it says based on this rally, based on the strength of the pullback, it's going to tell us where the upside targets for gold are. And so we can look forward and look above. Gold has the potential here to run to $3,722, and it can go all the way up to about $4,100. So if we look at that, you can see that's a 20+% move. And this is a very similar thing we saw in 2007, meaning we could see it not only hit this target, but it could become the crowded trade short temporarily, and we see gold blast through and move up to, $4,500 or something huge. It could really have a big move at this point. So
Yeah.
I like gold. It has this giant bull flag pattern. I'm waiting for an extra, like a discretionary trade, just a side trade that if gold starts to break out to the upside, I want to get long and play this move because I think it'll be a very quick move. I think it'll be very strong to the upside. And if you compare what happened in 2007, if we were to just scroll forward,
Right.
we saw the stock market fall 20% and we saw gold shoot up 37%. And I believe we could see something similar. If we were to fast forward this, we would see, the stock market potentially top out and start to sell off, and gold just keeps going higher and takes off. So that's an opportunity. This is a very rare type of setup that's unfolding. And I think one of the key things for, short-term traders is if we look at the price of gold futures here, and I think this is very important for people to understand, is gold did break to some new all-time highs on the futures market, but that's not what I follow when it comes to trading gold for a trade. I like to look at any gold, physical gold ETF, GLD or whatever. If we zoom in on the chart price action, you can see we never did hit new all-time highs back when futures did. So I'm really looking for gold to break above, when GLD closes above 1750 more or less, I'll be like, okay, you know what? This is it. This bull flag is breaking out, and probably we got chaos in the stock market. This will be kind of the play for gold. So gold has got huge upside potential, and I think it'll bleed over to silver and miners as well. I think the people who take physical gold are extremely savvy. They have a ton of cash because they're buying it. I think it's very smart to be loading up on physical gold because there's gonna, I think, eventually be a time, Daniela, when gold is shooting through the roof. Nobody can get their hands on physical gold. It'll be like impossible to get because anybody who has access to it is just buying it up. It's not even getting out to the public. I think getting your hands on it before, obviously, it rallies and potentially we're in a perfect storm for gold and silver to explode to the upside. I think getting your hands on it is important. That's what I do. I collect physical gold. I just store it. I keep stacking it. I think I don't really do gold for a trade. This
Right.
gold trade I just mentioned to you is like, I'll jump into an ETF. I'll play that move as a trade, but I do accumulate physical gold. I keep it stored away and I want to have it in hand. So people accumulating the physical, taking massive delivery, I think they're just really savvy investors saying, hey, if this does take off, they want to make sure they have it because a lot of people will want to buy it. And there's a lot of ways to buy gold and you actually don't really own it. There's a lot of different ways that it's done, that you might not actually be able to get it if you really did want it. And the whole world is all fighting for it.
Silver continues to shine, but with volatility, as the iShares Silver Trust ETF is up about 33% year-to-date in 2025, drawing attention from options traders who are capitalizing on elevated implied volatility. Silver remains more volatile than gold due to its smaller market size and dual roles as both an industrial metal and a precious metal. In the near term, analysts and institutions forecast silver to reach the $40 to $50 range, with a potential for $46 to $47 by mid-2026, supported by technical strength and growing industrial demand, particularly in the renewable energy and technology sectors. Meanwhile, the gold-to-silver ratio remains unusually high, suggesting that silver is still undervalued relative to gold. If this ratio reverts toward historical norms, silver could benefit substantially from mean reversion. Gold, on the other hand, is viewed as the global barometer of risk, signaling when something in the financial system is breaking down. Its current pattern suggests a major breakout ahead, with investors moving away from stocks and real estate toward gold. This shift is seen as a warning sign that uncertainty is rising and markets may be approaching a turning point. In essence, gold is flashing caution, while silver offers explosive but unpredictable opportunities. Let's redirect our attention towards the interview now.
So silver is wild. It has a very ugly chart. It has a lot of noise, huge pops and drops, big rallies, big sell-offs. It's definitely more volatile. And I think that has to do with silver is a lot more of a speculative play. It's a smaller market, so it moves faster. Gold I like because it's kind of the global barometer. It's the whole world gets nervous. When gold moves up, it means globally there's weakness and people around the world are seeing something bad happening on the horizon. And that's what the big chart of gold is pointing to, is we're on the tip of something hitting the news, something that's going to change everything. I think that's what gold is warning us. But silver does have upside potential. I mean, it's in an uptrend. I think it could rally to short-term wise. The next upside target short-term is about $40.75. Not that high from where it is. But as you know, silver, when it does take off, it kind of just shoots and goes ballistic. If we were to zoom way out on the chart, it can have these massive, explosive moves. And it's really tough to gauge. Silver moves very quickly. If you blink, you can miss it. You kind of have to be sometimes just positioned in it and stomach the volatility. And then if that hits, then you're a part of it. But a lot of times some of these moves happen in 1 or 2 days, some of these big pops and drops. But when we look back on this chart, there is potential, though. We see gold shoot higher and silver could go up and tag that, all-time high of $50. It could spike up to that level. It would probably do similar to what we saw back in 2007. We saw silver. Let's just zoom in on that price action. In 2007, we saw, just as the stock market really started to sell off, we saw silver shoot higher. Percentage-wise, on average, it moved up about 20% or so. And interestingly enough, the chart pattern for gold and silver right now, Daniela, is gold actually has more upside potential. It's the opposite of what you think. It's the opposite of what everyone else thinks. They naturally go to silver for the bigger gains. But for some reason, all of my chart patterns for silver, and even when you compare what happened kind of back over here, it has the same or less potential for some reason based on technical analysis than gold. So I like gold because it's stable and I think it's going to be a big move. But we'll just have to see how this unfolds. Obviously, silver, if we were to go back, silver did have a pretty massive run from these lows. It was roughly the same, about 40% or more from like what gold did. Gold did about 37 as it broke and shot higher. Silver also did about 37, somewhat from the same time frame. So you kind of pick your poison, spread your money between both if you wanted to, right? Exactly. I think gold to me is the ultimate tool of uncertainty, and it looks like it's about to pop and blow up to the upside. And I think we're on the cusp. I mean, a lot of people, I've been expecting a big market correction to come at any point. I'm not jumping in front of it and betting on a huge correction in the economy and the stock market. If it wants to keep going up, I'll follow the trends higher. But gold is just screaming. It's like something is about to break. Something is wrong. People are moving away from real estate. They're moving away from the stock market. They're going into gold. And it's just telling us, just be cautious, right? It's kind of that warning sign.
Gold is indicating systemic stress, while silver is presenting high volatility upside, and both metals are setting up for potentially significant rises. The undervaluation of silver and its industrial demand could result in disproportionate gains, even if gold is the better long-term insurance against financial turmoil. When taken as a whole, they show that investors are becoming increasingly concerned about the state of the economy and the potential move away from traditional assets. Could gold's rise surpass current forecasts if there is a significant decline in stocks? Will silver ultimately beat gold in the upcoming bull market era if the gold-to-silver ratio returns to normal? Post your ideas in the space provided for comments below. Please support and enable notifications if this video is helpful so that you can stay up to date with our latest videos. I'll see you in the upcoming video. Thank you for viewing.
Right now, silver looks weak compared to gold when you go back to 2011 high, but what's been going on for 5 months is a lot more strength in silver. I think that's going to continue, and I think it's going to get explosive. And I think we're going to look down in, a couple months, and we're going to say, oh, wow, finally, the beast is out above its all-time highs. It's like 60 or 70, which is sort of a broad working target we have for the next surge. If gold just stood still and silver went to 2% of it, silver would be $70 or so. But gold will be going up there in that time. It's just that silver will be outpacing it. So we think right now the place to be most focused in terms of holding a position. We said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000.
Silver is gaining momentum and looks set to outperform gold, with analysts expecting it to break past its old highs and potentially reach $60 to $70 as it catches up. Even if gold held steady, silver could rise to around $70 at 2% of gold's value, but since gold is also climbing, silver's outperformance is likely to accelerate. With gold's rally restarting and long-term projections pointing as high as $10,000 to $20,000, the strongest focus right now is on silver within the monetary metals. Michael Oliver is a seasoned market analyst and the founder of Momentum Structural Analysis. He explains that gold has spent the past 5 months consolidating in a sideways range, frustrating skeptics who expected a major correction. Instead of falling, gold held firm and is now breaking above $3,500, signaling renewed momentum. This pause acted as a cooling-off period, setting the stage for the next surge higher. Analysts suggest this rally will be powerful but not the final peak, with potential targets of $10,000 to $20,000 in the long term. Silver and gold miners are also showing strong outperformance, with silver expected to surge towards $60 to $70 before any meaningful pullback. Unlike past rallies, this move is supported by deeper global and macroeconomic shifts. The dollar index has been flat for nearly a decade, yet gold has more than tripled, showing that other forces are driving demand. Weakness in treasury bonds, signs of a topping stock market, and risks of a sharp Bitcoin decline could all funnel more money into precious metals. With these pressures building, gold and silver may see explosive upside before year-end, as investors rush to safe havens amid mounting financial instability. Before we begin, please subscribe and enable the notification bell so you stay up to date. We'd love to hear your thoughts, so please share them in the comments.
Well, gold's momentum is positive. In the 5 months of horizontal price action we've seen, it allowed all the doubters, and there are ever doubters out there. It's got to correct, it's got to go back to 20, this level or that level, some old high, and it didn't do it. They sold into it repeatedly. Like 3 times it got up to 3,500 or 3,450. Right now we did trade above 3,500 today, by the way, using October gold. They couldn't break it. They sold it and they kept getting these $100 and $150 pullbacks, and then bang, you're back up again. So I guess they got taught a lesson that this is not some beast that has to correct big time. Instead, it had a correction by standing still for 5 months. And our work on momentum and clockwork of momentum, meaning often momentum swings can be measured on certain of our metrics in terms of how many months have been spent trending up on the oscillator or down on the oscillator. And for that 5 months, we've had a corrective downside process in momentum as it cooled off while price went lateral. The clock is old. We said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000, okay? But we're focused right now on MSA on this issue. This particular surge will not end the bull market, but it will be dramatic. And therefore, if you're invested in the monetary metals, particularly the silver side, and the gold miners, which are now also outperforming gold, we're looking for points to take profits. But I'm going to tell you that in the case of silver, we're not looking for it, frankly, until we get to 60 to 70. Because we've blown out the idiot highs, which means, pardon me, those who missed the move, had ignored it and doubted it, will suddenly say, well, golly, I got to be in that. Okay. And then you get a further gush of money into a fairly small market, which could easily goose it into that zone. And we've got some reasons for that zone. But ultimately, there could be a correction up there, not the top. So if you're fully invested, unleveraged, ignore what I'm saying. Because I think we've been arguing that this move in gold and silver is different from the prior ones. This time, I think there's more fundamental and macro technical events going on globally and in major asset categories, not just a stock market top, which I think has been making since early this year. It's a widening top, but it's a topping pattern. But in certain other areas like the breaking of the dollar, dollar has not been a factor, the dollar index, when you measure it versus euro and yen primarily, that's 70% of the dollar index. It's been sideways since 2015 when gold made its low. It's trading around 98 right now. We're trading just below 98. So, yeah, it's been above it and below it since then. But 10 years, it's been net lateral. Well, why is gold not net lateral? It's triple and a half. So you don't just look at the dollar for driving gold, but it will help because it's now entered what could be a dynamic bear market. And dynamic on the downside could, in fact, be further win for gold. Then we go to the T-bonds. T-bonds are usually an alternative. If you have a perception of a weakening stock market, people will tend to move money into T-bonds as the alternative. They're not. T-bonds are very anemic. They're very weak. They're behaving more like the stock market in terms of when they make lows and highs. And right now, T-bonds, as we speak, are not far away from some levels that if they break below, you could end up getting a little mini bond market event, which would spook the stock market. Anyway, there's a lot of these factors out there, including Bitcoin, I think, which is in a potential crash situation. We've been saying that for a few months. Not that we're there. The trigger numbers are still below us, but if you hit those trigger numbers, that could suddenly become an off-the-sideline type, oh my God, where did that happen? How did that occur? And it will have wave effects because the financial institutions are now so heavily involved in crypto. So anyway, these events are out there percolating, and I think they're going to occur. And when they do, that could create further upside panic in the monetary metals. And I think we're going to see that between now and the end of the year, possibly sooner than that.
Michael thinks that gold's rise since 2015 can't be explained by the usual drivers like a weak dollar, falling stocks, higher commodities, or bond shifts. Instead, it reflects something bigger, deep distortions created by government control of money. These forces are converging, setting up a cascade that could spark central bank panic. Silver is expected to break past its old $50 high and surge towards $60 to $70, drawing in late investors before any correction. Still, that would only be a pause, not the end of the bull run. Historically, gold has delivered two eightfold moves in the past 50 years, and repeating that pattern today would put it near $8,000. Analysts argue this wouldn't even be unusual. It would simply mirror past cycles. Michael predicts that if gold does reach those levels, silver could climb dramatically as well, possibly reaching 2% of gold's price. Commodities may follow along, but the real fireworks are expected in gold, silver, and mining stocks, making the coming surge both dramatic and highly concentrated in monetary metals. Now, let's revisit the interview.
Explain, we showed in the weekend report the chart of gold since 2015, and there's this upward plotting action, and then it's accelerating. And you say, well, what caused that? And it wasn't because it was the declining stock market, which helps gold. If you go back 2000, 2002, 2007 high in the stock market to 2009, gold went net up. There was one break in there, but it kept going up. But we don't have that right now. So it's not the weakening stock market yet. It's helping gold, so we will, because money will move. It's not reflected by the bond market. It's not reflected in commodities. The Bloomberg pullback from a high at 140 to either side of 100 back in 2022, dropped in 23, and then went sideways, has been dull for a couple of years. So it isn't commodity prices, so-called commodity inflation. You look around, and it's not the dollar. The dollar has been Deadsville. It's recently started to drop, but it's not precipitous yet. So how can you explain this? Well, because there's something bigger going on. It's not merely one of these things. It's a combination of things, largely built around the distortions created by government monopoly over money. And gold knows this. And later on, you'll see the headlines and you'll look back and say, oh, now I know why. But don't look for the reasons why to be in your face as it's doing it. Look for them later. Too late to be joining. Okay, not too late, but you're late. Okay, already you're late if you're not in. So that's why I think things will change more dramatically this time, is that all these factors, not just one of them, and all of a sudden now we have a lot of factors that are at the point of cascade, which would create what? Total panic on the part of central banks. Well, for silver, I think we'll take out the 50 high, and I think you'd at least go to 60, 70. And at that point forward, once we cleared that high and sucked in a lot of late money, grabbing it, a wet bar of soap stuff, there'll be a point to take some profits on a trading basis. Not that the move is over, okay. But if you historically, and I've said this over and over, and I'm not predicting the price because I think it'd go way beyond it, gold has had a couple eightfold moves. 1976 low to the 1980 high, eightfold gain. 2001 lows, 2011 highs, eightfold gain. Well, we started from a low at 1,050. You want to do the math? Somewhere between $8,000 and $9,000, you would simply be reflecting what it's already done twice in the last 50 years since the U.S. government legalized it. Okay? So to go to $8,000 now and gold would simply say, oh, it's doing what it did before, which isn't even abnormal. But what we're talking about is something far more abnormal. And therefore, you could go way beyond that on a fundamental or technical basis. But right now, even just echoing what it's done twice before, the same dimension move, you go to $8,000 gold, wouldn't shock me one bit, particularly when these other factors start to come into play, which I think could be in the next month or so. Anyway, so that would give you an idea. Well, gold maybe go to 8,000. Well, that's just, again, it's just doing what it did before. Is that a top? No, probably not. But it's a statement of, goodness knows where silver might be then. You want to put silver at 2% of 8,000, okay? Anyway, that's what I think we're shaping up for. And I think it's going to be dramatic. And it's going to be very isolated, very focused in monetary metals and their miners. I think to some extent commodities will coattail, not lead, not cause, but coattail gold in this up move, much like they did in the late 70s, where commodities coattailed the bull market to the 1980 peak in gold. They didn't match it in terms of upside, but they did coattail it. And I think we could see that again. But I think it's not outlandish to think of $8,000 gold. Now, again, what does that mean? Well, a little more than doubling where you are now. Is that a big deal? I don't know.
Michael Oliver highlights that both gold and silver are entering a powerful new phase, driven not by traditional market factors but by deeper systemic distortions in the global monetary system. With gold potentially targeting $8,000 to $20,000 and silver set to surge past its old highs towards $60 to $70 or more, the precious metals market may soon witness one of the most dramatic bull runs in history. This rally, fueled by weakening confidence in traditional assets and central bank actions, suggests that silver and gold miners could offer some of the strongest opportunities in the coming years. If gold were to reach $8,000 or higher, how high could silver realistically climb relative to gold's value? Do you think central banks will intervene directly in the silver and gold markets if the rally becomes too explosive? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.
Obviously, I could adjust my silver up, a bit. I mean, it wouldn't surprise me to see 40, 42, who knows, maybe 50, right? I mean, and I didn't say silver wouldn't, I said just basically don't bet on it. I think silver is bullish at the moment. Gold at the moment, I mean, today, price of gold's down 2%. Will it be up 2% tomorrow? I don't know, maybe. But, we're in a bull market, a long-term bull market for all these reasons, and probably both metals. I'm just less excited about silver, for these reasons. But yeah, I think in both metals. And, for the rest of the year, would it surprise me if we fell short of 3,600 in gold? No, it wouldn't. Would it surprise me if we surpassed 3,600 and we resume the march up and we see 3,800, 3,900? No, it wouldn't surprise me either.
Silver might fall behind gold's momentous rise, but that may leave more room to run when the gray metals rally takes off. With renewed retail interest, sustained industrial demand, and another supply deficit, silver enthusiasts expect prices to reach $40, which aligns with the average expert price forecast for 2025. His benchmark rises to $50 when looking to 2026. Gold regained momentum after losing ground in the days following the announcement of tariffs on April 2, as investors sought safe haven assets. According to the bank's economists, there's a 45% chance of a U.S. recession within the next 12 months. If that happens, the analysts said gold could hit $3,880, $3,800 to $3,900, by the end of the year. Keith Weiner, a U.S. economist and founder CEO of Monetary Metals, points out that a recent U.S. customs ruling, suggesting tariffs on 1 kilogram and 100-ounce gold bars, briefly sent gold futures to record highs, disrupting global bullion flows and threatening New York's role as a key price hub. Markets yanked back once the administration clarified that gold would remain tariff-exempt. Weakening global currencies, excessive government debt, and its status as a non-sovereign financial asset continue fueling its safe haven appeal. Analysts expect continued strength, despite temporary pullbacks. Volatility amid tariff uncertainty would be beneficial for gold. Central bank purchases of gold also continue to rise amid a de-dollarization push driven by the administration's tariff policy. Investors have been riding the gold gravy train all year, according to the latest gold demand trends report from the World Gold Council. Gold ETF inflows reached 170 metric tons in the second quarter of 2025, valued at nearly $400 billion, marking the strongest first-half finish since 2020. Silver prices have dropped to their lowest in over 8 weeks. Unlike gold, which thrives as a haven, silver has yet to follow suit with similar gains. Markets increasingly view silver through the lens of industrial performance, especially vulnerable given sluggish factory data and new tariffs, casting a shadow over its near-term outlook. Before we begin, please click the bell icon and subscribe to stay up to date on our latest uploads. We always value your thoughts and feedback.
Yeah, so this is one of those things where, unfortunately, there's a lot of bad takes out there in the gold community. And these bad takes all have the same recipe, which is something happened, and therefore, because something, that's going to cause the price to go up. And it always leads to the price to go up. Good news, the price is going to go up. Bad news, the price is going to go up. No news, the price is going to go up. And so we thought that, when Trump took office, there was going to be tariffs on a lot of things, and there was a fear that that was going to include, gold and silver, which would have been really bad. I mean, it would destroy the futures market in the U.S. and force it to go somewhere else. And then we got clarity. No, it doesn't apply to the precious metals. Okay. And it doesn't apply to copper and some other things. Okay, great. Then, I don't remember when that was. Seems like it was a couple of months ago. It does apply to copper after all. So that's really going to kill everybody who manufactures with copper in the U.S. And create some perverse incentives. So, cars don't use that. I'm trying to think of what really uses a lot of copper, but it'll make sense to manufacture that in a low tariff country and import it as a finished good rather than importing the copper and manufacturing it in the U.S. So some very perverse incentives there. But we got on Thursday, it came out that some big trader or refiner had asked, I think it was the U.S. Customs Agency, for a ruling letter to clarify the status of gold. They wanted legal clarity so that they're not risking not paying something they're supposed to pay. And, and obviously they want to make their plans and their investments. Nobody wants to invest money only to be told by the government later, actually, your investment is rendered useless because of this tariff. And the letter came back and said that kilo bars and 100-ounce bars are tariffable. They're in the category that's subject to tariffs. Well, that sent the gold market into a tizzy, because apparently that takes effect immediately. Let me talk about kind of the difference of silver versus gold. Silver is much more the working person's precious metal. And when you start to see the jobs market, which wasn't really all that strong for, blue collar, trades. Yes, certain trades at certain times, if you're in the building trades in certain booming cities, I'm sure there was unlimited work. There was a period of I'll call it the unlock whiplash after COVID lockdown was over, where, truckers, had all the work they could handle and more. But overall, the market for, people that are working with their hands or doing a skilled trade, just not been that strong a market. Now, certain niches within white collar knowledge workers like AI, scientists right now are getting these like $100 million packages. It's almost like reading about sports stars. You read about Michael Jordan getting a package like that, and now it's like these AI guys are getting it. But silver is the savings of tradespeople and blue collar workers. And now we're seeing the job market roll over, and that's going to hit, that segment, hard. And in addition, silver has this industrial component. And if manufacturing and all those other things are rolling over because of tariffs, for example, and also because this boom is just really long in the tooth. We're basically in one long boom that was juiced up when in spring, or was it March, April of 2009, the Financial Accounting Standards Board said, you don't have to market the losses. And so the banks were able to restate their financial statements, and suddenly they looked a lot better. And that was pretty much the day that the market turned around and began to boom again. So we're in this hell of a long time, 16 years and counting of boom, which is very long by any historical standards. I think we're well into record territory. So that we could be rolling over just because of that. Tariffs aren't going to help, all kinds of other things. And so silver, because of manufacturing demand falling off a bit, and because of working people savers just having less to save, I would generally expect silver to underperform. Now, could silver outperform in the short term? I think there's a lot of forces building up to suggest it could. Because the asset speculative class is seeing silver now. So if they jump into it, almost anything's possible in the short term. But gold, yes, because all the currencies, remain in this horrible bear market, and every government around the world has gone all in on madness, and it's getting madder, right? So we elected Trump as a protest against the profligate, stupid spending of the Democrats. And what do we get? A big, beautiful spending bill that accelerates spending even more. And of course, gold responds to that because it's just, it's just a hedge against being a creditor to the government, which is what, if you hold the dollar, you're effectively a creditor to the government. And when the government's becoming something that embarrasses even drunken sailors, you don't want to be a creditor. Well, look around. What asset can you buy that's a financial asset that isn't being a creditor to the government? It's gold. So yeah, we're in this gold bull market. Silver, I think, medium to long term, not really. Maybe it'll keep up with gold to this point. It's not going to outperform. Short term, yes, there could be a big pop in it. That wouldn't surprise me, given everyone can see the chart patterns and say, wow, silver's going to pop. And then they'll make it pop, right? But, is the real long-term demand there for it?
Silver's resilience is evident compared to previous years. Since the start of 2024, silver has gained over 50%, demonstrating increasing appeal for investors seeking diversification and growth potential in precious metals. Renewable energy, particularly solar power, continues to fuel demand. Despite some uncertainties for U.S. renewable projects under the current administration, global solar installations are expected to hit new records in 2025, all good news for silver. The solar sector's appetite is so large that by 2050, it could consume nearly all of today's known silver reserves. Geopolitical tensions add complexity. Russia and Mexico, two of the top silver producers, face ongoing political and regulatory challenges that could further restrict supply. Silver's reputation as a safe haven is growing amid economic uncertainty. Volatility stemming from tariff threats and policy shifts since early 2025 has prompted investors to seek tangible assets, such as silver. Interest rate expectations also matter. Even if rate cuts slow, sticky inflation suggests real rates could fall. Silver is set to hit $40 this year and $50 by 2026, according to Peter Croft. The silver stock investor author credits the simultaneous rise in industrial and investment demand, ongoing supply deficits, and positive market metrics for this bold price forecast. Under the right conditions, Croft even thinks silver could explode to $300. Even famed silver investor Eric Sprott shares a similarly ambitious expectation of $250 to $500 silver. Let's redirect our attention towards the interview.
There's a point at which there isn't even necessarily an explanation. Now, the silver people will talk about structural deficits. Now, they've been talking about structural deficits since before I got into this. I sold my company in August of 2008. So we're exactly 1 week away, a week and a day away from the 17th anniversary of that sale. Right, that was August 19, 2008. And when I started reading about this stuff in fall of 2008, they were talking about structural deficits for silver. Now, if the price moves, especially sharply in a short period of time, you can't look to a 20-year-old story as the explanation. It's like the left says, oh, consumer prices went up this month because of greed. Wait, are you saying there wasn't any greed last month, and this month greed came into the market and that's why prices went up? Like, if there's something that's basically a constant, greed is a constant, and the alleged structural deficit in silver is a constant as well. It doesn't explain change to the margin. So a lot of people may cite that, but at some point sentiment, takes over, and then everybody, wants to buy. Yes, it's true in places like India, if gold is perceived to be too expensive, it's also out of reach for, very large numbers of Indians just don't have. A minimum wage in India is between $2 and $5 a day. So it doesn't afford them, much if any gold. Silver is much more affordable. So, if gold becomes less affordable, there'll be some switch to silver at the margin there. That's true. And that can drive it a little bit. Silver is a smaller market. But at the end of the day, I think it's sentiment. The sentiment can be self-fulfilling for some period of time. As it was, I think there was non-sentiment factors as well in 2011, but look at what happened to silver in the first part of 2011. Right, we shot up in late 2010, silver was under $20. And by, was it March? Did it hit peak or April in 2011? It was $50. So boom, 2.5 times. And then we spent how many years in a bear market in a silver wilderness? So the sentiment, when it turned. It was done. And that first day that silver dropped from $49 to 30, was it 35 or 34? It's like within a day. And all the smart people were like, silver's done, stick a fork in it. It's not going to recover the $50. This is not a market correction. This is wicked volatility. This is a bear market. If you have a loss, take your loss and move on. If you still have a gain, lock it in and move on. This thing is done. And it was for a long, long time. We still haven't recovered. 17 years later, we're getting closer to recovering. Could it go to 50 and beyond? It could. Will we see 30 on the gold-silver ratio again? No way. To see 30 on the gold-silver ratio, we'd have to see over $100 in silver. Keith Weiner, August 11, 2025. You're not seeing $100 on silver anytime soon. Not going to happen. It is what it is.
Although industrial headwinds and uncertainties surrounding tariffs may cause silver to lag behind gold in the near term, its long-term fundamentals remain solid. With projections of $40 in 2025 and $50 in 2026, silver is poised for substantial gains due to its continued industrial application, particularly in solar energy, as well as rising demand and supply constraints for safe havens. In the meantime, gold is still growing thanks to central bank purchases, safe haven flows, and a deteriorating macroeconomic environment. If recession worries materialize, it might reach $3,900. In an unpredictable global economy, both metals remain essential for investors seeking growth and safety. What possible effects might current tariff measures have on the equilibrium between the industrial demand for silver and its attractiveness to investors? If the need for manufacturing and renewable energy around the world recovers more quickly than anticipated, may silver's anticipated surge surpass gold's gains? Leave a comment below with your opinions. Please like this video and subscribe for future updates if you liked it. We appreciate you coming along on this adventure.